A great pleasure to welcome you all on Direct Tax Refresher course, which is a signature event of WIRC. I request our chairman, WRC CM Murtaza Kachwala sir, to please escort our chief guest, Shri G.S. Pannu sir, Honorable President ITAT. And it's really a privilege to have you in our program, sir. Requesting Chairman Direct Tax Committee, Hitesh Komal sir, Vice Chairman Direct Tax Committee, Piyush Chandak, and Treasurer, accompany to our guest. Please be on the dais. Friends, we have Honorable President ICAI, Honorable Vice President ICAI has also joined us virtually. I welcome you all. And before starting the session, I request everyone to please rise for the ICAI motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you. Lighting the lamp is in a way an evocation of waves of knowledge that are activated on stage. It is also means keeping the waves of knowledge generated on the knowledge imparting stage constantly active through the medium of the flame of the lamp. So let's begin with the lamp lighting. So now I would request to our chief guest, sir and Chairman WRC, please light the lamp and officially inaugurate this session. Requesting all the dignitaries, all RCM, Regional Council members, Central Council member, our speaker, Sridharan sir, please join us for the lighting of the lamp.
Deep
everyone. Now I would request Chairman Direct Tax Committee for his opening remark. Hitesh Komal, sir, please.
Good evening. Very respected and honorable chief guest of the program, ITAT President Sri G.S. Pannu sir, Honorable President of ICAI, CA Dr. Devasis Mitra sir, young and dynamic Vice President of ICAI, CA Aniket Talati ji, energetic Chairman of WIRC of ICAI, CA Murtuza Kanchwala, Secretary of WIRC, CA Sweta Jain Madam, Treasurer of WIRC and Vice Chairman of our Direct Tax Committee of WIRC, CA Piyush Chandak, my other colleagues in the WIRC, and all the delegates who have joined physically as well as virtually today. I hereby welcome you all to this feast of knowledge. Friends, we have gathered here for our prestigious annual event, that is Direct Tax Refresher Course 2022, starting from today, and it will continue for next 3 Saturdays, that is 25th June, 2nd July and 9th July 2. In this DTRC 2022, our endeavor is to cover most relevant topics with regard to direct tax laws, and that ranging from penalty provisions, tax aspects for redevelopment project, laws on reassessment, laws dealing with the economic offense and black money, tax considerations for partnership and LLPs, tax aspects related to charities, and taxation of dividend income. We have invited highly acclaimed and eminent faculties to share their wisdom and to enrich the knowledge of our members on the relevant subject. I request all the delegates to take the maximum benefit of this feast of knowledge. Thank you very much and wish you all a very happy learning. Thank you.
Thank you, Hitesh Bhai, for briefing about the structure and mostly designing this course. Thank you so much. So friends, we are thankful to our chief guest, G.S. Pannu sir, ITAT President, for gracing the occasion. And now it is our duty to welcome him. So I would request our chairman to present a bouquet and welcome him at WIRC. Welcome you, sir. So going forward, now I would request our chairman WIRC, CA Murtuza Kanchwala sir, for his welcome address.
Thank you, Shweta. Good evening to all. A big thank you to CA G.S. Pannu sir, President ITAT. Sir, thank you very much for accepting our invitation and joining us here physically today, sir. Extremely grateful. I recognize presence of Honorable President of ICAI, CA Dr. Devasis Mitra sir, Honorable Vice President C. Aniket Talati sir. A big thank you to both of you for joining virtually and taking out time from your busy schedule. Extremely grateful, sir, for joining us. I also would like to thank Chairman of Direct Tax Committee Hitesh Komal, Vice Chairman Piyush Chandak, the 3 people who helped us in designing this course, along with both the Chairman, Vice Chairman, CA Drushti Desai, CA Amaya Kunte, who joined us virtually, CA Shekhar Patwardhan. Guys, extremely grateful. Such a good program, nicely designed, excellent faculties, and we look forward to listening to all of them. Thank you. Thank you for all the efforts in organizing this program. My office bearers here on the dais, and also all the regional council members and all of you friends welcome to you. We got about 200 plus physical registrations and people are coming in slowly. And we got 600 plus virtually. So a big thank you to all for joining this signature event of WIRC, the Direct Tax Refresher course. At WIRC this year, the theme is leap towards excellence, achievement and development. And we set up 5 goals and we identified various activities that we want to achieve. And we also set out some measurable criteria. But the 2 things which I would want to touch upon is, like, one is technical updation and the second is technologically whatever we can bring to all the members and students. And in technical, we definitely want to touch upon the direct tax. And here we are today with the direct tax refresher course. We are designing an indirect tax refresher course. We already done with one Ind AS refresher. We are currently going on with an accounting standard refresher. We are also designing a refresher course on the international gaps and one on insolvency, bankruptcy, cooperative, internal audit and risk management. So multiple of them. And we would like to bring everything to the members and maybe they can pick up whatever area of practice they want. In addition to these refresher courses, there are a lot of smaller 2 hours, 3 hours programs, physical as well as virtual, which keeps on happening. During this year, we have also embarked upon again a journey of doing various courses on technology, and be it Tally Prime or be it an hands-on on idea tool or be it like a program on Fusion of Excel and Tableau. So we'll try to bring about various technology. I want to especially touch upon only one thing on the technology front. We started a certificate type of we give a certificate of participation, a 60 hours course where we are teaching data analytics, Python coding and SQL. It is on a Saturday evening, Sunday morning, and the fees is only 9,000 rupees and you can sit at home and do it virtually. We completed 4 batches of 30 each, successful, very good feedback. The 5th batch is going on and we'll keep on launching the batch every month. Part 2 of this we have started, and there we are teaching the viewing solutions on Tableau and Power BI. 40 hours again, 6,000 rupees fees. And we merged both of these and made a 100 hours program for students as well for as low as 6,000 rupees. And we are also working on a 3rd thing, which will be covering the robotic process automation. And we'll be wanting members to get hands-on experience on automation of various activities. So a lot of action on the technology front will happen. We request everyone to join wherever, whatever, and take the benefit of it. Happy learning to all of you. Look forward to host you for all the 4 Saturdays and anything we are here to serve you. Thanks a lot. Thank you very much.
Thank you, Chairman, sir, for giving us a highlight of our vision and activities as WIRC. And here I would request you to all please join us in a large number and support us in achieving our goals. So friends, today on the occasion of Direct Tax Refresher course series, we are releasing our most awaited publication, which is need of every chartered accountant. So, and we are fortunate to release this by hands of our chief guest, J.S. Pannu, sir, Honorable President, sir, ICAI, CA Dr. Debashish Mitra, sir, and Vice President of ICICI, Aniket Talati, sir, who has joined us virtually. So, can we also, it's a WRC reference manual 2022-23. And also we are coming up with an official directory of WIRC 2022-23. So,
Friends, it is now time to hear from our torchbearers of the profession. I would like to introduce before you our beloved Vice President from our region only, CA Aniket Sunil Talati. Sir, I'll be very brief. CA Aniket Sunil Talati has been elected as the Vice President of ICAI of the Institute of Chartered Accountants of India for the term 2022-23. He is at the forefront of the digital transformation within ICAI, technical advisor to the ICAI nominee on the PAIB advisory group of the IFAC, technical advisor to the board member of SAFA, and he was chairman of Ahmedabad branch of ICAI for the year 2014-15 and executive committee member of Gujarat Chamber of Commerce and Industry, GCCI. With this, I present before you, Vice President, sir. Over
Thank
to
you.
sir.
Thank you so much, Piyush ji. I hope I'm audible.
Yes, sir.
To the very respected chief guest of this direct tax refresher course, our very own CAGS Pannuji, Honorable President of ITAT. Thank you so much, sir, for gracing this occasion. And I think truly, sir, with your presence, the DTRC has been glorified even further. It's our marquee event of WIRC. And I think Chairman could not have had a better person to inaugurate it. So thank you very much, sir, once again for being amidst us today. To the Honorable President, Dr. Debashish Mitra ji, sir, welcome to our region, though virtually, and we look forward to your guidance and the vision about our profession. So I will refrain myself on discussing that, but so look forward to your guidance to all our members who have joined physically as well as virtually. CA Murtuza Kachwala, the Chairman WIRC, the Secretary Shweta ji, the Chairman and Vice Chairman of the Direct Tax Committee, Hitesh Pomal ji, Piyush Chandak ji, the galaxy of regional council members, past regional council members, and I believe some central council members also, though I couldn't see the other side who are present. A very good afternoon to all of you, and it's my true pleasure to address all of you at this inaugural session of the WIRC's marquee event of the year, the DTRC. I think it is one event that members, not just in Mumbai, but across the country look forward to, because it is probably the best course on direct taxes that happens in the entire country. And I'm glad that this year too, Murtuza ji, under your leadership, we have continued this very important tradition of ours. And I think you have used this COVID reoccurrence or the another wave that we are seeing right now in Mumbai to the best effect, so that you have converted this event into a hybrid one. I remember in the past, we used to have almost 1,000-1,500 physical participants attending the DTRC also. But today you have managed to do it in a hybrid fashion. So compliments and congratulations to you. I was particularly pleased to mention and to hear when you talked about Tableau, Power BI, and the steps that you are taking on technology. I think technology is definitely going to be a huge game changer, not just in our profession, but every walk of life. And the direct taxes is no different. I think 5 years ago, if we had discussed faceless assessment or anything of that sort, it would have been probably unimaginable. But post-pandemic, I think things have been accelerated. ITAT hearings are happening virtually. High courts have functioned virtually. And our entire mechanism of working with the income tax department has moved virtual. So very important for our members also to upgrade themselves on technology. And that is why in the new course curriculum that is being proposed, we do not have a separate subject on technology, because it is the council's belief that technology is a part of every subject. So therefore, now when we will be doing our chartered accountancy, it may not be accounting, it will be accounting with embedded technology, so that ERP and other mechanisms can be taught along with teaching accounting. Similarly, direct taxes will also have a very important aspect of technology embedded into the course. Similar to technology, what we are doing is we will have ethics as part of every subject, because technology and ethics is the cornerstone and going to be the future, very essential for all our members. And when I'm talking about ethics, I will borrow from our Honorable President, who quoted our past president, I think a lion of the profession as far as direct taxes is concerned, Bansi Mehta ji, who said that ethics is absolute and never relative. So relativity, in other words, is in physics, never in ethics. And I think we all have to understand that it is going to be very important going forward as chartered accountants and as professionals that we maintain the highest levels of ethics. Sir, you quoted two past presidents of our region yesterday, Bansi Bhai Mehta and of course Y.H. Malegam Sahab, who also, I think, mentioned a very important line that the profession in the future cannot be driven by the excellence of a few, but competence of many. I think these words that Y.H. Malegam sir has written has a deep meaning. The profession cannot be recognized by excellence of few good tax professionals or few outstanding chartered accountants who are doing well in the direct tax area. It will be very important that the competence of many, that is all our membership, is ensured. And I'm glad that this DTRC is aimed at ensuring that overall level of understanding of direct tax laws amongst our membership is improved to a large extent. Very happy to see very important topics being covered on partnership, LLPs, charities, the Black Money Act, of course, reassessment, which is a very important bone of contention, which is happening today. My only request finally to all members would be that the Accounting Standards Board has come out with a very important publication, which is the format of financial statements for non-corporate entities. And majority of the participants who are attending this conference are looking at non-corporate entities tax audit season, which is coming up. My only request and urge to all of you would be, let us try and adopt this technical guide of the ASB when we are doing the tax audit function for majority of our clients, so that the financial statement quality across the country can be brought up and we can ensure a good level of compatibility between different financial statements of proprietors, partners, LLPs, etc. And LLPs more particularly, because we have all heard that the government is currently considering how accounting standards can be made mandatory for LLPs. Therefore, more important for us to appreciate the need for standardization. So once again, I hope you all use this technical guide. I would request that when you take up that session, please share that format, the chairman and Hitesh Bhai, to all the members if possible, so that they can take maximum benefit of this important publication of Accounting Standards Board. I once again thank the WIRC for inviting me, for giving me this wonderful opportunity, and special thanks to our chief guest, GS Pannuji, and of course our Honorable President Sir, for sparing their valuable time and being with us today. Thank you very, very much.
Thank you, Vice President, sir. After listening to him, it is time to hear from our dynamic and dedicated President of ICAI, CA Dr. Debashish Mitra, sir. It is my pleasure to introduce.
No introduction required. No introduction required. I will straight away start off. No introduction required. Thank you very much.
Okay, sir. Thank you very much, sir.
All right. All right.
Welcome,
You
sir.
see,
Welcome.
thank you. Thank you very much. Thank you.
Over to you, sir.
Yes, thank you. The chairman of WIRC, Murtuza Kaswala, Shweta ji, most important, the chief guest for this evening's program, GS Pannu sir, because I think he has been a friend of the institute. He is a chartered accountant himself, but if you meet him and the warmth that he shows towards the profession, you see, you cannot have a better friend of the institute than CAGS Pannu. And I congratulate the WIRC for having, ensured that he's the chief guest for this program. The Honorable Vice President of the Institute, Aniket Talati, Chandrasekhar Chitle, who is also a very important person in the sense that he is the chairman of the Direct Tax Committee of the Institute. And to everybody else who are listening to me, a very, very good evening. Once again, I compliment Western Regional Council for having been successful in ensuring the presence of CAGS Pannu amongst us. Let me tell you, it is not very easy to get him. So I compliment all of you that you could get him. Very good. Uh, Yesterday, I was with the Honorable Vice President in Baroda. And there, you see, he was in glowing terms speaking about this program that you are having, this direct tax refresher course. He was saying that how it is a marquee event of WIRC. And you see, he was speaking about the event. You see, he was telling me the various aspects of the event. So I'm very happy that West India Regional Council is carrying on the practice of hosting this event. Let me tell you now, see, Chandrasekhar Chitleji is here. When faceless assessment came, about which the Honorable Vice President was mentioning just now, the profession faced a challenge because we were not very conversant of facing or of having a situation where we do an assessment maybe under section 143(3) of the Income Tax Act faceless. The profession was really not geared up for that. But then let me take you back to 2017 when GST was introduced. Pre those days, the profession was basically direct tax centric. The profession did not have much interest in indirect tax. But once GST was introduced in 2017, the profession saw an opportunity that you see in GST, that you see there was an opportunity to be had. What the profession did, it adapted itself and it changed itself. It took some time. It took some months for the profession, but then it got the grasp of GST. And a predominantly direct tax professional, you see, in a few months also became an indirect tax professional. Similar was the challenge when the faceless assessment came into being. You see, we were all conversant with one-to-one, you see, in-person hearing. The faceless assessment came, and the requirements were different. The requirements were more of your drafting skill and your knowledge of the law. Those were such important requirements. And the Institute of Chartered Accountants of India, under the leadership of people like Chandrasekhar Chitle, who is in his second term as the Direct Tax Committee Chairman, got publications out, ensured that we spread out throughout the country, educating the membership about the change scenario and the change requirement. The point I'm trying to make is that the profession has this ability to adapt itself to all changes that comes in the way. So when you have a faceless assessment situation under direct taxes, we have adapted ourselves. I'm extremely happy. When I did my articleship, many people, they know me for corporate laws, accounting standards and all this. But when I did my articleship, for 3 years, I was only dabbling with Income Tax Act 1961 and the Income Tax Rules 1962. You see, for 3 years, I was only dabbling with this. And, I used to enjoy the Income Tax Act. I do. Even though now being the president and having administrative responsibilities, I do not get the time to really open the book and enjoy. But let me tell you, I'm very happy that West India Regional Council is organizing this course on a subject which I think has been part of the DNA of the profession. Direct tax has been a part of the DNA, just like accounts and audit. Today, Aniket, rightly so, talks about technology. Yes, you see, we are talking about technology. I am also talking about technology. I'm talking about sustainability. I'm saying that the reporting in the future will be all about, will be to a great extent about non-financial areas rather than the financial areas. But there is no denying the importance of direct taxes. I'm very happy that West India Regional Council, giving full importance to this subject, is organizing this refresher course. I wish the deliberations great success. I hope that the delegates who will be listening to speakers of repute, would be very enlightened by the deliberations that take place. And needless to mention, I wish Western Regional Council great success in all its future endeavors. Thank you very much.
Thank you very much, sir. I recognize the presence of our Central Council member C.V. Chitle, sir, who is also the chairman of Direct Tax Committee of ICAI. And with this, now it is time to hear from our chief guest. And I am privileged to give his introduction before you. Honorable G.S. Pannu. He is a president of ITAT, and before that, he is a chartered accountant as well. And his full name is Gunjit Singh Pannu. He is BCom from Punjab University, Patiala, and stood first in university. During his professional career, he was active in the activities of Institute as well, and he was the chairman of Northern Regional Council of the Institute of Chartered Accountants of India. So, sir ने गुणों के साथ में लोगों के दिलों को भी जीता है. Sir had joined ITAT in 2000 as an accountant member and served that position at Bangalore, New Delhi, Chandigarh, Pune, and Mumbai benches. He was elevated as Vice President in 2018 and held the charge of Vice President Mumbai from 18 to 19. Also held the additional charge of Vice President Chennai Zone from 19 to 20 and Vice President Delhi Zone from 2019 onwards. He has made significant contribution to the organization where he has been posted as the member or vice president both in the fields of administrative and judicial work. He has been heading various administrative committees of the ITAT. Under the chairmanship of G.S. Pannu sir, Computerization Committee of ITAT has been instrumental in harnessing the benefit of information and communication technology in judicial and administrative areas of work in line with the Digital India policy of the Government of India. Committee headed by him is working on the implementation of paperless courts in ITAT. With this, I present before you Pannu sir. Thank you, sir. Before that, I'll request our chairman to felicitate our chief guest with the memento as token of our love and affection.
My friend and my president, young and dynamic, Mr. Debashish Mitra. I say my president because I'm a chartered accountant first. And of course, young and talented chartered accountant and son of a very illustrious CA. Anikit Talati, the Vice President, the young leadership of WIRC, led by the Chairman WIRC, Murtuza Kachwala, the faculty for the evening, Sridharan, and all the chartered accountant friends, brothers and sisters who are present here. Sorry, I forgot Mr. Chitle. One of the places which I really love to have served there for 5 years, Mr. Chitle, Pune. It goes back to Pune days when I first met Mr. Chitle there. Well, it's always like a homecoming whenever I'm invited for any of the programs for the Institute of Chartered Accountants, WIRC or NIRC, or any of the regional councils or even a small branch also. And coming to WIRC is always an eye-opener, yes, because WIRC has a legacy to live on, because you have been doing such wonderful work within the regional, amongst the regional councils, that perhaps you owe your preeminence, you owe it to your hard work over the years that you have done. I remember when I was the chairman of the Regional Council in 2000, and I won't be apologetic about it, but North is always looked upon as something which is very disruptive in its approach in the Regional Council. I could be there only for 6 months, and the other 6 months was carried forward by my colleague office bearers there. But that was the only year perhaps we came close to clinching the title of the winners of the annual competition when we were the joint winners perhaps that year. I really wish I had continued for the rest of the 6 months, perhaps the things could have been different. But all the same, what is important today is that the institute has a very unique role to play. I thought the leaders of the profession are here, the president and the vice president both are here. The chairman of the direct access committee is there. I think perhaps the institute is doing a yeoman's service so far as the education part of it is concerned, upgrading the knowledge, upgrading the curriculum, keeping it in tune with the times, the requirements, also keeping an eye on the number of chartered accountants required in the economy. All that is doing, it's doing it very well. The student-related activities, the activities which relate to the chartered accountants in practice or in service for that matter. The vibrant activities at the regional council level, at the chapter levels, at the committee levels, in the main, at the national level, all that is what is happening is really remarkable. And of course, with the policy framework of having some dedicated and minimum number of CP hours, that is also being very, very well looked after. I would draw the attention of the leadership to something which is perhaps is there for the asking, and we need to take a lead role in that. Before I spell it out, I would just like to dwell on how the tax policies, the fiscal policies of the world over are being developed now. So we all are witnessing the exchange of information, the BEPS action plan, the multilateral information MLIs which are being formulated, the G70 or the G20 or G7 when they came up with even talking of working out some common minimum tax rates. So the methodology which is taking place is that there is a consensus-based approach even on having a universal taxation all across the world. And that's the need of the hour, of course, because the businesses, as the cross-border transactions are taking place more and more, the businesses are growing from one place to other place. You need uniformity, you need certainty also in the different sovereigns that we have. In such scenario, there need to be a voice which is unbiased. Unbiased qua the sovereignty, qua the lobbies of profession or professionals, qua the stakeholders of the businesses, and which better institution can be there than the ICI for that matter? Because institute has multifaceted activities, and one important activity which is required for it to shift is not only represent the professionals, but also represent the profession. Why is it that the institute does not have a seat in the UN for that matter when we talk of broad basing the tax? Why is it that the institute by itself does not have a seat on the OECD for that matter? The voice there, which is unbiased. So therefore, that's one area where perhaps the institute can take a lead. Yes, it's all right to present before the parliament, before the government in framing the tax policies. But it's another matter to conduct research to see to it that equitable, acceptable, consensusly better acceptable policies and tax frameworks and regulatory frameworks are worked out all across the world, and the institute does the research in it for that matter. the WIRC will take care, and the NARCs and all will take care of the professionals and their activities. But somewhere the institute will have to come forward and bring forth the true value of looking at the profession. Anyway, that's something which I have perhaps felt over the years when we look at the dynamics and the developments in the economic world which are happening all across. And I, for that matter, find that my mother institute, for that matter, is best placed to take on that role from hereafter. So far as your direct tax refresher course is concerned, in fact, when the message came from your office bearers, it was indeed, of course, a delight. And when I was traveling, I suddenly remembered that perhaps the last, when I addressed this kind of a session, was in the Birla Auditorium, just next to our office. And it was a huge number of people, which one could see. Gone are those days, perhaps, with the pandemic and the use of technology, which has come in play now. But I'm glad that the institute has been able to immediately reorient itself and organize itself in such a manner that the members do not feel the want of even the physical gatherings as big as in the Birla Auditorium, for that matter. Well, the topics that I have seen, they are also very, very interesting. And I have heard one or two speakers, 2-3 speakers, the way I have seen that I've heard them even from the benches. And I'm sure that they'll be able to lead the topics and they lead the discussion to a very high order. But at the same time, I would again emphasize that there should again be some topic, some special session where you could also deliberate on how the taxes should move forward, how the tax regime should move forward. So ultimately, as I see it, chartered accountants have a very, very unique role to play, apart from its institute. That's I've just spoken about it. But so far as we as CAs are concerned, we are very, very uniquely placed. We can find ourselves in any role, for that matter, in the economy. Some of our prestigious administrative services, they are being handled by our chartered accountants. They are not only in the finance, they're running the commercial ideas also in the business world. They are in this online administration also, for that matter. Our commerce minister happens to be, and so there's so many. So therefore, if you fit in everywhere, for that matter, then you must also fit in as to how the Indian tax ethos should move forward. I think there should definitely be some deliberations on that point of view. Another aspect is that when you go out and advise your clients, when you represent your clients, we have seen it from the bench that more often than not, the tax advisors do venture into the field of aggressive tax advisories, as well also aggressive tax interpretations. It's all the same. It's fine. It's not something which should be frowned upon. But the other side of the story should also find a caution with the business world. Whether to go in for an aggressive kind of interpretation or to go for a conservative or a safer interpretation, I would put it like that, that should be a business decision left to the businessman, for that matter. That's where the distinction between an advisory role of a chartered accountant should stop. So long as he's able to put forth to his businesses that, look, these are the pitfalls, these are the risks, and these are the two approaches. It should be left to the business to understand and take it forward. More often than not, I think in our exuberance, to see to it that the interpretations that one professes succeeds, we fall into the pitfall of clinging to it. And speaking from the bench, so far as ITAT is concerned, this is an institution which has been there for 1941. Much of its glory, much of its work that we have done from the bench, contribution from the profession of chartered accountant has been immense. Because not only has the profession contributed towards the ITAT's presence from the bench, where we have our accountant members who are drawn majorly from the chartered accountants fraternity, but also people who are presenting before the tribunals. And chartered accountants, as a part of the tax bar association, the tax bar of the ITAT has been phenomenal. Some of the legendary names were also taken by Aniket when he was talking about Mr. Pansi Mehta and Mr. Maligam and all. So those are legendary figures. They have all contributed to the growth of the profession as well as the institutions like ITAT for that matter. So therefore, when we are that kind of importance in the society, in the economic development of the country, we must steer clear. Be sure that our clients know the pitfalls of getting into the aggressive interpretations of the sections and the aggressive tax planning that is involved in certain situations. This will also enable us to deliver back to the society what we owe it to it, our social responsibility of contributing to a society which is based on rule of law. Because ultimately, India is one of the most vibrant democracies of the world. And the fulcrum of the entire society is based, our constitutional pillars are all based on being rule of law for that matter. And that is where we professionals, it's not only the domain of the lawyers, please, also us as chartered accountants, we have to be very, very clear on that we have absolutely good role to play in that. Well, coming back to what we have gathered here, I have absolutely no doubt that the kind of deliberations which are going to take place, the topics that have been selected, and as the speaker before me did state that one of the interesting one is the law on reassessment. In fact, I looked at it and was telling the chairman, your chairman, that perhaps this will be one area of discussion which will be much looked after. And with the Supreme Court judgment coming in and its implementation in the process, and with people gearing up to respond to the notices. Now, that's one thing, again, I want to emphasize. See, with the kind of assessment which are taking place now, the transformation of getting into faceless assessment, the faceless appeal authorities coming into picture, more and more emphasis is going to on the writing skills of the professionals. I remember when I was at the regional council, that was the year when we advocated and the institute very successfully did it. They introduced that course of communication skills with the chartered accountant, which was lacking at that point of time very much. Similarly, I think even at now, it's not late, the regional councils, the branches, the chapters, they must come out and equip this virtue in our chartered accountants, the writing skill, the drafting skills. Sridharan will not have a problem, obviously. He's a lawyer also. But as chartered accountants, we are very good. We have an analytic mind. We can read very well. We can understand very well. But believe me, a young chartered accountant who's always busy in his audit affairs during his articleship does require some kind of help at that stage of his career to be a good communicator vis-a-vis the writing skills are concerned. And that's what is going to be the forte in the times to come. So therefore, that's something which perhaps your regional councils can adopt. And I'm confident the team that you have at the present with the WIRC is doing a good job. You have an excellent leadership at the national level. And I would then close by saying that, well, it's always good to be here with all of you and good to see that the numbers are also increasing, as your chairman was saying. And this is one place where you can always be more enriched, because knowledge, if you share with others, you don't become poorer for that matter. And there are institutions, there are branches which are average size in number, there are lesser number of members. I think what you should advocate in those branches is the syndication approach. Today, individual practices are no longer the order of the day. You need to syndicate and you have to be specialized in your own fields. And that's something also which perhaps bodies like the regional councils, the infrastructure that you have created, they should be available to the members as such to leverage for their profession also again. Well, I congratulate the team WIRC and also thank them for having invited me for this function. Thank you very much.
So friends, it was a very enlightening session. importance of technology with ethics. These words from our Vice President, sir, is really valuable for us. So thank you so much, sir, for addressing to our participants. Our President, sir, has touched upon about the faceless assessment and drafting skill, which is really prerequisite now for us before appearing to the ITAT or any assessment proceedings. So thank you so much, President, sir, for taking out your time from your busy schedule and guiding us. So what we understood from our chief guest address, this is the use of technology of development is everywhere, and how tax regime should move forward is now talk for the discussion. So sir, thank you so much for an eye-opening session. I request everyone, please join me with a big round of applause in presenting a hearty vote of thanks to our Vice President, Sir Aniket Talati, our President, Sir CA Dr. Devashish Mitra, and our Chief Guest, Sir CA GS Pannu. Thank you so much. And we are concluding here our inaugural session, quickly moving towards our first technical session. Thank you so much.
All right, friends, good evening, everyone. Please show some energy. Good evening, everyone. Thank you. That sets up the first technical session, the background for the first technical session. Now request Pinky Kedia, Regional Council member, to please escort the next speaker. And I request all of you to please give some energy. Please applaud. Please put your hands together for Chartered Accountant and Advocate V. Sridharan, sir. I also request Advocate and Chartered Accountant Sriram Srinivasan to please join us on the dais. I think it's important that we recognize the efforts of people who are behind this wonderful presentation that are being carried by faculties like Sridharan sir. So I think thank you, Srinivasan, for being around. Friends, so this direct taxes DTRC has come up in a very important time, as our chief guest for this evening, Pannu sir, mentioned the Supreme Court judgment, ratifying 148 section. I think very, very difficult and very, these are some decisions that really don't go well. They are not well digested about, how can a Supreme Court have this kind of a view. Sometimes we feel that, isn't that harsh? Isn't that, what do we call that term, tax terrorism and all of that stuff? But whatever it is, I think it is for real. So, this DTRC therefore becomes very much crucial as to what should our role as professionals should be. Also, we are amidst the wonderful section that has come up, 194R. So I think any business promotion that you do now, you keep a share of 10% to the government also. So, you keep the corruption or keep the extraordinary payments in check, keep a trail of them also now. And, so many other things are happening. And of course, where's the screen? I am assuming people are there on online is on, right, it's on. I also welcome in this session, the session chairman, C.A. Chandrasekhar Chitle sir, our council member from Pune, has joined us virtually. I think he's one person who really minces no words when he has to talk about real direct tax, what is happening at the direct tax committee. He is one person who guides every now and then about whatever that the council is doing. And especially when all of these kind of decisions are coming up and, kind of actions are being taken. So the role of government really looks very clear and sharp that what they want to bring is in harsh discipline. And as rightly mentioned by Pannu sir, writing skills is something that now would become predominantly important and something that would really tilt the scales in our favor. So with this introduction, with this small little, outburst of my own feelings against whatever is happening in tax, I believe I would request Chitle sir to please join us and please share his address for this session. Over to you, Chitle sir.
Thank you, Arpit. I see at my table plan where the faculty was supposed to address at 4:38 p.m. We have started 20 minutes late, so we have already taxed the audience by delaying the process. I don't want to further penalize them by addressing. I would like to speak about the activities of Direct Tax Committee, etc., but maybe on some other occasion whenever WRC team feels appropriate. Only as far as penalty is concerned, we have moved from the regime of concealment, inaccurate particulars, to underreporting and misreporting. So really all the participants, including me, are eager for the purpose of listening to the speaker. So rather than dilating on anything, I would like to conclude. And I welcome the speaker who is very learned. And I'm sure that the participant would be more interested in listening to the speaker. Thank you.
Thank you, Chitle sir. And now may I request, please let's present a memento and welcome our speaker with a flower bouquet. I request, I'll be happy to join Pinky madam while we present that to Sridharan sir.
Thank you, Arpit. It's my pleasure to introduce today's speaker, today's technical session speaker, Advocate CA V. Sridharan. As you know, our human mentality is that कि जब तक fine या penalty नहीं लगता, हम लोग कोई चीज follow नहीं करते. So, what is the law of penalty in our income tax? It will be covered by our learned speaker. Mr. Sridharan holds a degree in mathematics from Madras University and a law degree from Delhi University. He is a qualified chartered accountant and a cost accountant also. Mr. Sridharan was the founding partner of the law firm Lakshmi Kumaran and Sridharan, a leading firm of advocate in indirect tax, anti-dumping and WTO laws. IPR laws, he is practicing since 1983. He is a session lawyer possessing vast experience and has successfully litigated on important and very heavy tax matters for nearly 3 decades at the Supreme Court of India, High Court, and the Custom Excise, Service Tax, ITAT and sales tax tribunals. He has been instrumental in assisting courts in deciding important questions of law and development of law in the field of taxation. He has been designated as senior advocate by the Honorable Bombay High Court in 2011. Mr. Sridharan areas of practice includes direct tax and all indirect tax such as GST, customs, excise, service tax, sales tax, VAT, entry tax, etc. In the last decade, he specialized in GST laws of UK, European Union, and New Zealand and Australia. He is also a regular speaker on these various subjects. With this brief introduction, I request you all to welcome him with a great round of applause. Sir, that is yours.
Good evening. I'm told I'm late by 20 minutes, but I'll finish in time.
So it's not you are late, we made you late. My apology for that.
I can correct that also.
Yeah.
Yeah, no problem. Don't worry. We will see. The institute sent me a invitation about 3 months ago, etc. And today morning got a call from the chairman. Sir, you are coming. I said, sir, what? I didn't know. And they said, we have told your secretary. My secretary came and told me. I said that meeting is next week. He went away. There is a lecture for NIRC on next Saturday. So I was thinking he's reminding me about that. So I forgot about this. So whatever I have prepared is in the last half a day. So it will be somewhat superficial. I don't know whether you were all there last week in Pune. I narrated a small story. I never realized that will backfire on me this week. And I'll tell you the story. And that happened today. Come, Sriram. I'm with my colleague Sriram. Sharmaji knows him very well. Okay. I was telling an incident which the TP also told me. There's a senior lawyer, Mr. Daftri, who's a Solicitor General, Attorney General in 1950s, 60s. At 10:20, some junior came running to him. Sir, our case is the first case before Chief Justice. Then the Daftari sir picked up some papers, something, maybe an old newspaper also. Went to the court and told Chief Justice, my lords, there is inconsistency in the witness of the statement of prosecuting witness number 3 and prosecuting witness number 4. Criminal matter, no? So Mr. Daftari said, sir, there is an inconsistency in the evidence of prosecuting witness 3 and 4. Then one judge says there is inconsistency in 1 and 2 also. Then second judge said between 5 and 6 also. Chief Justice said if so many inconsistencies, we have to admit the appeal. So the appeal got admitted. So Daftari had not the papers, he has not seen. He was only, junior only told him it's a death sentence matter. I was narrating the incidents last week that as professionals, we must be thoroughly prepared. But sometimes, due to circumstances, you are told at the last minute to appear in a matter. You cannot say, sir, my preparation is imperfect, I will not appear. So I was narrating the incident last week, little realizing that it happened today to me. Anyway, the topics given to me is penalty qua 270 AA and penalty on directors in income tax. These are the two topics, not generally about penalty, but otherwise. Okay. Okay. Very briefly, Inherent meaning of penalty, we'll have a rough idea and then we will go into this. This is not a filler preparation. It is important for the matter. The first point is a penalty provision in taxing statute merely a matter of machinery, or is it a substantive provision? I repeat, the first and foremost we must keep in mind is whether a penalty provision in a taxing statute is merely a matter of machinery or is it really substantive? You may ask, what are these jargons mean, sir? What is the meaning of these jargons? What is the effect of this? If it's a matter of machinery, then we all know rules of interpretation of machinery provision is to make the machinery workable. If it is a matter related to substantive charge, then the provision should be construed strictly. And any ambiguity in the language should go in favor of the taxpayer. So if it is a substantive liability, two interpretation possible, one in favor of the assessee. Any ambiguity in the language will go in favor of the assessee. It's a matter of machinery, then you have to interpret it so as to make the machinery workable. This is a very important point, and that's why I'm referring to it. It is possible some portion section 270A may be a substantive, some portion of it may be machinery. It's also not necessary the whole section should be either machinery or whole section should be substantive. Some portions can be substantive, some can be matter of machinery. I give two examples, both from old income tax. These judgments are obscure. And I will then tell you a judgment of Supreme Court in sales tax, which is not there in this slide, and a judgment of the Supreme Court in central excise, applying this, distinguishing these principles. In the first two cases you are going to see in the slide, Abraham case and Bhikhaji Dadabhai's case, Supreme Court took the view that penalty is a matter of machinery, not a substantive charge, to some extent like that. Subsequently, in Anvalari's case, Justice Pathak distinguished them. And then I'll be referring to sales tax judgment in Kemka's case, 1975 Supreme Court, Constitution Bench, and a central excise case of Supreme Court on Orient Fabrics. I'll explain that in a minute. In Abraham case, matter, as you know, C.A. Abraham is a typical Malayali name. Okay. So in Kerala, we had the Travancore Income Tax Act. And when India became independent and Cochin and Travancore became part of India, for assessment year 50-51, Income Tax Act applied. But that section says, for the past, provisions of Travancore Act related to assessment will apply. I repeat, the 50-51 Income Tax Act for 1922 Act for the year 50-51 says for the past period, provisions of Travancore Act for assessment and collection of tax will apply. The assessee was a partnership form, it was dissolved. And dissolved partnership form, Income Tax Act says you will assess the partner to tax. So the dissolved form, partner said, all right, I'll assess you to tax, no problem. This allegation of concealment. Therefore, they wanted to put penalty on him. So the section says assessment of partner of a dissolved form will be governed by the Travancore Act. Assessee says, sir, therefore look at the Travancore Act for imposition of tax only. Because this section in the Income Tax Act 22 says assessment provisions of the Travancore Act will apply. He says you cannot put penalty for me because the Income Tax Act 1922 borrowed the provisions of Travancore Act only for assessment, and therefore penalty is not leviable on the partner for concealment, though he is liable for tax. In this context, Supreme Court rejected it and said, when the section says partner is liable for assessment to tax as per the provisions of the Travancore Act, and in Travancore Act, this chapter relating to assessment one section related to tax, another related to penalty. The Supreme Court stunningly took the view that penalty provisions of Trivandrum Act will also apply for levying penalty on the partner of a dissolved firm. That's what Abraham's case is. Next. Similar question arose in this Dadabai's case. This is from Hyderabad income tax. Some part of our Maharashtra fell under the old Hyderabad state. Same question. Supreme Court followed Abraham's case, and assessment to tax, provisions for assessment to tax can be borrowed for levying penalty also. This question again came before Supreme Court in income tax 61, in Anwarali's case, the famous judgment of Chief Justice R.S. Pathak. We all know that. This real question arose in that case was, assessee failed in assessment proceedings. Assessment proceedings became final. For the addition made in assessment proceedings, he was subjected to penalty. He was subject to penalty in the as a consequence to the failure in the assessment proceedings. Assessee argued that I failed in assessment proceeding to tax, no doubt, but I have no better explanation as to why I should not have assessed to tax at all. Assessee said, sir, tax is paid, is gone. I'm not asking for refund of that. But when you are wanting to put inflict additional burden on me, want to put penalty on me for concealment of tax, I can prove to you the tax itself is not payable. Then Annarali's case is a famous judgment of the Supreme Court. It says assessment proceedings and penalty proceedings are separate. What is the meaning of that sentence? Assessment proceedings and penalty proceedings are separate. Not because assessment in chartered accountant, unlike our excise in GST, we don't get two bites of the cherry. The officer passed same order of tax and penalty in the same order. So we get one appeal only, we get one appeal fee only. In income tax, you have an assessment order separately, you have a penalty order separately. For every time, you get two fees for two appeals. That doesn't happen in sales tax or excise or customs, etc. Okay. Why the Supreme Court said assessment proceedings and penalty proceedings are different and distinct? Though it is a continuation of the assessment proceedings, it is different and distinct. Supreme Court took that view because even though assessee might have failed in the assessment to tax proceedings, he gets a second chance to show in penalty proceedings that assessment on tax made by him is wrong. And tax department cannot say the assessment proceedings become final, it will operate as res judicata, and you will not be allowed to reopen that question. Supreme Court says you will not be allowed to reopen the question and get a refund of the tax paid. But certainly you can resist the penalty on that. So first thing Anwarali said, assessment proceedings and penalty proceedings are independent, though it's a continuation of it. Second, Anwarali distinguished that Abraham's case and Dadaji's case, saying, if you ask the question whether assessment to tax, procedure for assessment to tax will include provisions for penalty, that's a different question. The Supreme Court said liability penalty is substantive. There should be, just as you have a charging section for a tax, you must have a charging section for penalty. I must tell you frankly, when I argued that Supreme Court case in Orient Fabrics, I first argued before Delhi High Court in Pioneer Silk Mills and then in the Supreme Court. Pioneer Silk Mills I argued in 1993 or 94. I thought we always have a charging section for tax. You never have a charging section for penalty. As a youngster, a charging section to tax ke hota hai, penalty ka ho sakta hai. But there is a charging section for tax. There is a separate charging section for interest. There is a separate charging section for penalty. So what is applicable, saying charging section for tax and then assessment section for tax? Similar concept apply for penalty also. So Supreme Court says there has to be a substantive charging section for penalty, and penalty is a substantive liability and not a matter of machinery. That's what Anwarali case said. And all this will be relevant when you approach 270A. Then the Supreme Court judgment, central sales tax in Kemka is very important. It's a 3-2 by Constitution bench judgment. That case, assessee filed a return, said tax due as per the return is 10,000 rupees, but did not pay that tax. That is, return was filed, admitted tax was not filed with the return. In the Bombay Sales Tax Act, there is a provision that if you file the return without payment of the tax, you are liable for penalty. And Central Sales Tax Act said, provisions of Bombay Sales Tax will apply for levy and collection of Central Sales Tax. I repeat, Section 90 of the Central Sales Tax says, provisions of Bombay Sales Tax will apply for levy and collection of Central Sales Tax. So the state government argued, look, in Bombay Sales Tax, I have a section that if you don't pay the admitted tax along with the return, you are liable for penalty. We have now filed a return of Central Sales Tax showing a liability of 10,000 rupees. You did not pay that. And Section 90 of the Central Sales Tax said, provisions of Bombay Sales Tax will apply for levy and assessment of tax. Supreme Court now held that liability to penalty is substantive liability in Kemka's case. And Justice M.H. Beg, the Chief Justice, said, just as for a tax, there is a charging section, there has to be a charging section for interest and penalty. Absent a charge, penalty is not leviable. Penalty is not a matter of machinery. Therefore, that there is a provision in the Bombay Sales Tax Act for collection of penalty. And there is a provision Central Sales Tax saying provisions of Bombay Sales Tax will apply for assessment and collection of tax of CST, corresponding will apply, will not mean penalty provisions of Bombay Sales Tax can apply. By 3-2 majority, Supreme Court held that view. C.A. Abraham was distinguished. I don't know about Dadabhai's case. Subsequently, to overcome the judgment, amendment has been retrospective Central Sales Tax. That is as Palkivala sir writes in his book, a familiar sequel. Once the assessee succeeds in the Supreme Court, a familiar sequel is a subsequent retrospective amendment. So that's a different matter. So we've seen Abraham's case and Dadabhai's case. Then we saw Anwar Ali's case. All are income tax cases. Then we saw Kemka's case in Central Sales Tax. Then we have this judgment of the Supreme Court in Orient Fabric, which is a Central Excise case. In Central Excise, on some commodities, you have 2 excise duties, one under the main act, another what we call Additional Excise Duty Act. So it's an Additional Excise Duty Act applied to some commodities. That Additional Excise Duty Act said, provisions of Central Excise Act will apply for assessment and collection of excise duty, additional excise duty. I repeat, there is one basic Central Excise Act. There is one Additional Excise Duty Act, separate. Additional Excise Duty Act says, provisions of Central Excise Act will apply for assessment and collection of additional excise duty. The party evaded additional excise duty. There is no penalty provision separately in additional excise duty. There is a provision in Central Excise Act for levy of penalty. A question arose, therefore, where Additional Excise Duty Act said, provisions of Central Excise Act will apply for levy and assessment and collection of tax. Penalty provisions of Central Excise Act can be borrowed for levy and collection of penalty for default assessee on additional excise duty. Supreme Court this time again held, following Kemka's case, it cannot be done. I'm referring to this. I also remember an old Allahabad, 1930 Allahabad, we used to have one thing called super tax. Income tax and super tax used to be a concept pre-1965. And penalty for concealment of basic tax will not automatically apply for super tax. This is a judgment of Allahabad High Court also. So this concept is relevant because many times we have this BMA Act and other supplementary acts which borrow the Income Tax Act. If they are careless and do not borrow explicitly penalty provisions, this principle in Kemka and Orient Fabrics can apply. The other important point from these judgments is they say liability penalty is substantive liability and not a matter of machinery. And if there is no separate charging section in the act imposing penalty, you cannot impose it indirectly by implication from the basic act. These are the principles which flow from these 4 judgments. Anything else you want to say, Sridhar? Sure. Some of these propositions need to be carefully seen. Okay. They are not of universal application. In a slide, you cannot capture all the exceptions and provisos, then it becomes complicated. Okay. Liability to penalty is not automatic. We don't have self-assessment penalty so far. Is it not so, sir? Huh? We file a return, self-assessment of tax is there. I'm sure someday Parliament will come up with self-assessment of penalty also. Abhi tak nahi hai. There is no automatic liability penalty. Okay. Penalty largely, if the section says shall be liable to a penalty equal to 100% of the tax. Okay. A question arises whether it is mandatory. What is that textile process, justice passage judgment? Famous income tax case only. Just getting old. Just 1 minute. I'll give you in a minute. Section says you shall be liable to a penalty. If it also has a word, whosoever willfully evades, whosoever deliberately evades, then willful and deliberate has to be proved. But many times sections say, if you delay the filing of the return, then you shall be liable to a penalty equal to 1% of the tax. There, the liability penalty is automatic. Automatic in the sense, you need not have to pay along with the return. Officer will pass the order still. If the section says, shall be liable to a penalty not exceeding, then again it becomes not mandatory. Or as the MVAT Act says, may be liable to a penalty equal to 100% of the tax. If the word uses may be, then Justice Chandrachud says, once it says may be liable to a penalty equal to 100%. Then they say either he can put 0 or 100. He cannot put anything in between. So use of the word may be liable to a penalty at the rate of 100%. Then the word may also makes it discretionary. Or if the word used as deliberately conceal particulars or willfully, wantonly, if those words are there, then also menseria is required. But if those words are absent and it simply says it's a delay in filing of the return, you're liable for an penalty, then penalty may be automatic. Some judgments have said, if the section gives you, says you must give an opportunity for hearing, that also is indication that is not mandatory. If it is automatic, then the computer gets, CPC itself can do it. The fact that section says you'll give a show cause, opportunity, etc., also points out there's an element of discretion, but that's a debatable point. Okay. Last slide is only for lip service, but in practice doesn't happen. Penalty proceedings not to be initiated as noticed by Vanchu committee only to harass the assessee. All the amendments made in 1975, which made this penalty provision draconian, are based on Vanchu committee recommendation. Okay. When the committee recommends, government has accepted the major recommendation of the committee. That's what they will say. What is ignored will be this. Okay, next. This is a famous sales tax judgment, which is quoted repeatedly. Hindustan Steel. Just because it's lawful to levy penalty need not be levied. It cannot be levied for every venial and trivial breaches, or if the disputed questions of law, you cannot levy penalty. But depends on the language of the section. So Hindustan Steel applicability is greatly diluted by the language of our section, which you'll see in a minute. And Mr. Sorabji always used to say, Hindustan Steel is Old Testament, Cement Marketing Corporation. This Hindustan Steel 1971, Supreme Court, and Cement Marketing is 1980. These are famous judgments which sales tax lawyers repeatedly cite. I don't find income tax lawyers citing it that frequently. Therefore, I am referring to this. These are two judgments which are useful to us to explain that the penalty proceedings are quasi-criminal and it is not liability, is not automatic. The reasonable explanation, no penalty is impossible. General principles. Come on. Next. Now we come to our section 270. A. Sharmaji was telling me, sir, now old 271 1C says concealment of particulars, right? Or what is the other word? Inaccurate particulars. Those words are not there. And 1964 deliberately furnished inarticulate particulars. That's what deliberately was there. That was omitted in 1964. And then we had a section, if the difference between assessed tax and return tax is more than 20%, deemed to be concealed unless you explain, shifting the burden. Then you have all this explanation 1, 2, 3, 4, etc. We will see. Explanation 2 of old 271 will be very, very useful for understanding 270A. I want to give you a small tip. 270A subsection 4 and 5 are based on explanation 2 to old 271. Okay. And judgments in the context of explanation 2 will be relevant for subsection 4 and 5. That is one. More than that, it shows the true nature of 270A also. We will see it in a minute. So now these words are not there. So is that automatic? And according to me, the most useful subsection in 270A will be subsection 6, subsection 6 clause A, 270A 6A. If you take maximum advantage of this, we can completely frustrate this section because the section is draconian. I'm not saying we should ignore our liability to the society, I mean response to society, etc. This section is draconian, okay? And the only way, as Mr. Palkiola says, you can humanize the section. Approximate the section to cause of justice. Beautiful word. Approximate the section to cause of justice. Even now, you will not be able to get complete justice. So you only approximate. Approximate it to the causes. This section should not be used as an instrument of oppression. That's another word he has used. The section should not be used as an instrument of oppression. You humanize the section. Make soul in it. That can be derived from subsection 6 clause A. That's what my recollection. We'll see that when we see 4 and 5 and 6A. So according to me, in view of this subsection 4 and 5, which is similar to explanation 2 and subsection 6A, principles which were earlier laid down can apply to significant portion even now. That's what we like to elaborate. And as usual, all the amendments which are against the taxpayer, the memorandum will say rationalize and simplify and bring it objective to do it. Whenever they use the word rationalize, you can assume rationalize in revenue's favor. That's the only meaning of these sections. Hi, Yogesh. Oh, okay, let's go. The scheme of the section is slightly structured. And since it's not already been mutilated by amendments, it makes easy reading. After 5 years, you can take it from me. There will be any number of amendments in this section, and you'll not be able to know which section, where it begins, where it ends. Today, at least it makes easy reading. Okay. Subsection 1, which is the main charging section. Any person who has unreported income shall be liable to penalty, in addition to tax, if any, on the underreported income. Yeah. So the words used are shall be liable to penalty in addition to tax, if any. The word you already seen the word in addition to. If there is no tax payable, then no penalty. That is taken care of by the word. And the word if any. If none, then also you'll be liable. So the word if any and in addition to tax. Subsection 2 and 3 explain what according to them is the definition of unreported income. And then measure of that. how to compute. We'll see that in a minute. Subsection 4 and 5, which are inspired by explanation 2, says in some cases, intangible additions are made in the past, then you will not be liable for penalty under this section. And the importance of subsection 4 and 5 is not merely situation covered by it. I repeat, we'll see 4 and 5 in detail in a minute. The importance of section 4 and 5 is not merely confined to situation dealt with by this. In these situations, if intangible additions have been made in the past and assessee now introduce a deposit and says this deposit is made out of intangible additions, you may be liable for penalty in this year. That's what the section says, unless you have not been subject to penalty in the past. The importance is not on this. It contemplates that there can be intangible additions even now, which will not be liable for penalty. So the importance of subsection 4 and 5 is a legislative recognition within the same section, contemplating that there can be situations where even though disallowance are made, penalty may not be levied. So the very existence of subsection 4 and 5 leads us to this important inference to say that 270A penalty is automatic, ignores the underlying principle decipherable for subsection 4 and 5. And subsection 6A virtually says, if you give a proper explanation, then again penalty will not be levied. We will see that when it got introduced in 1976. Okay. If the explanation is not false, you give a factual explanation, but are not able to substantiate it, then again no penalty will be levied. So 6A can be used to substantially mitigate the otherwise seeming rigor of subsection 1. 7, 8, and 9, we have this provisions in GST. If there is no concealment, then assessment can be done within 3 years. If there's a concealment, if the short levy is due to fraud, then 5 years. You have similarly in 147 also, that where you have fully and truly disclosed it, then 4 years, otherwise 6 years. Now again, so if the penalty, the addition is a consequence of misrepresentation or suppression, then the consequence, then this a higher penalty will apply. We'll see that in a minute. And there is a definition in subsection 9 for definition of what is misreporting. Okay, so I started 1 hour late. Okay, I'll finish in time. Broadly speaking, underreporting is very broadly put, if there is a difference between returned income and assessed income. Others are variants where no return is filed or case of reassessment, etc. So underreporting is if there is any difference between even 1 rupee difference, at least that section in 64 says if the difference is more than 20%. But now even there is 1 rupee difference, it can be case of underreporting as per the definition. Okay. So anything and everything will satisfy the definition of subsection 2. Again, and then this is the formula for case of 115 JB, nothing new in this. We need not go into that. Misreporting, misrepresentation or suppression of facts, failure to record investment in the books of accounts. I read the section the first time today. So I was still checking with Sridharan. When I buy some small jewelry, of course, fortunately, I buy for my wife who is in income tax. So we buy in credit card only. So that is a record of it. Okay. But my accountant always records his drawings. Then somebody may say you are not shown a personal jewelry as investment in the books. It may attract this penalty section. The way the section is worded, it is recorded, paid out of taxable income, credit card payment, but in your this thing, he debits it to the drawings account. So failure to record investment books of accounts, Sharma ji, isme aayega na sir? Because it's not unexplained, I may get away. But if you look at it literally, failure to record investment in books of accounts. Okay. Claim of expense is not substantiated by evidence, which is after with GST with fake invoices floating around. So this is very okay. Then recording a false entry, outright false entries. And I'm told now the stage of planning is so advanced that anticipating a search, we used to argue, sir, this is found at time of search itself and therefore has to be genuine. Then now the structuring is so advanced that you anticipate a search and provide for it also. Recording a false entry in the books. Then recording failed to record the receipt also. And last is your transaction, international transaction with associated enterprises. Failure to report international transaction or specified domestic transaction. I want to comment on the last one only. Failure to report international transaction automatically is presumed to be case of misreporting, and penalty is that two times or whatever it is. Old 271G. I first want to make a point. I'm not sure. I'm not saying I'm right. Suppose there is a genuine dispute or doubt as to whether it's international transaction, and therefore don't report it. Then also section won't apply. If there is no dispute, it's international transaction between associated enterprises, and you don't report it, maybe the section may apply. This is the foundational fact for attracting the section is it should be an international transaction and you fail to report it. If there is really a doubt as to whether it's international transaction, because a transaction of capital nature is not international transaction within the meaning of the section. Suppose you want to raise a contention, then section won't apply. If it is international and fail to report. So any doubt about the first leg of it, section may not apply. This is what I wanted to. This is prima facie update. Okay, next. So, this clause A of subsection 6. No, let's see this. I want to be sure of that. Just give me 1 minute. I'm an old timer, therefore write down in my hand so that I don't forget it. Yeah, actually 6A. Yes. This is the most important section in the whole 270A. And according to me, this, if I may say so loosely, robs the section of much of its vitality, they say. But that's what the legislature intends. You may say, revenue may argue, sir, this interpretation of subsection 6 clause A robs much of the vitality of the section. But if the legislature enacted it, then revenue cannot have a grievance. And it says, the amount of income in respect of assessee offers an explanation, and assessing authority is satisfied that the explanation is bona fide and assembly disclose all material facts. The fact that your explanation is not found acceptable ultimately on merits doesn't mean penalty is mandatory and 270A is attracted. So according to me, clause 6A is an important exception. Fact should be disclosed that ultimately fail in merits is no ground. So this really 6A is another way of putting on a genuine legal dispute. No dispute on no manipulation of facts. Penalty is not leviable, is retained by 6A and not abrogated by 6A. This is the most important point I want to explain. Rest is all B and C. I was told, I didn't understand it. The underreporting is an account of error in the base of estimate. So I was asking what it can be. Or subsection C, so clause C says, amount of underreporting is determined based on estimate. The assessee has his own estimated lower amount of additional disallowance and officer disagrees with it. Then also there is no 270A. So I was asking what can be estimate, etc., which can attract. I was told, suppose I'm not good in these things. You all know better. Suppose there is a project which is spread over 3-4 years and you have methods of accounting, contract costing, project costing, etc. Then some people say work certified will be included. Work done, not certified will not be included. Some such thing may be there. So where the income is spread over a period of years and therefore income for that year, because section says you maintain books of accounts properly, completely. And since there is an estimate, it can be only a situation of that type. B and C may relate to a situation of that type. But not maintain books of accounts is not what is dealt with by B and C. Amount of income to the ways of estimate, the accounts are correct and complete. But method implies that the income cannot be properly reduced, and C will be this. So B and C are somewhat odd and peculiar, but clause A is universal in its application. Facts are undisputed. Your explanation to resist the disallowance is unaccepted, doesn't mean you will be liable for penalty, and is identical to explanation 1 introduced in 1975. So case law on that will continue to be relevant. And you got 4 and 5 also subsection? No, sorry. I have not produced this subsection 4 and 5. Broadly speaking, the budget circular explains, the CBDT memorandum explains in 1976 or whatever it is. Intangible additions are made against the assessee. Subsequently, 4 or 5 years later, he makes an investment on office and shows in the books. Officer asks, explain. Assessee says is out of intangible additions made in the past. Then the circular says, I cannot put penalty in this year because he has given satisfactory to the investment. In the past, I did not put penalty on him because it was only intangible addition. Officer was thinking, I may not be able to justify a penalty. But when the previous years, you have been assessed only to tax on intangible additions, and officer did not put penalty, you take advantage of it and explain an investment in this year as coming out of this. The explanation said, in then such case, if you have not been put to penalty in the previous years, I'll put penalty now. And subsection 4 and 5 are copied from that. I am told one of the principles which all bureaucrats follow is, when they are doubtful, please repeat what is there in the old section. It's a golden rule they follow. They say, we don't know why the section was introduced. We do not know what will happen if you drop the section. Okay. According to me, 4 and 5 has no meaning and context in 270A. But legislation enacted it, and you can therefore draw full mileage. The mileage is not confined to that case that you have made intangible additions. Now, subsection 4 and 5 is a legislative recognition of the position that any and every addition does not result automatically in a penalty. That's the inference we want to draw. I repeat, we are not considering the petty point about intangible addition, etc. The underlying theme behind subsection 4 and 5 is that there can be disallowances which will not attract penalty. And how that's clear meaning of 4 and 5. Therefore, that takes away the point. The 270A is automatic, mechanical, computer itself can do it, all bakwas. Coupled with 6A. This is what I wanted to say. Anything else? Sir, I didn't know. I was asked. 2-3 minutes only. Director's liability. I was thinking they must be asking the question wrongly, because in customs and the GST, for all default by the company, penalties on the directors also. But income tax with the nahi hai karke. Then I was told there is one section 270. What is that? Yeah, 270. 271 AAD. I never knew this section, but I was just told. Then, of course, I knew there is a corresponding provision for prosecution in right in the beginning. When the section done? No. Just see that. I will just tell you in a minute. (277A). This 271 AAD, which I didn't know, subsection 2 is somewhat widely worded. It's a practical relevance. You must all be aware of it. The assessing officer may direct that any other person who causes the person referred to in subsection 1 in any manner to make a false entry or omits or causes to make an entry shall by way of penalty be liable to a sum equal to aggregate amount of such false or omitted entry. The tax is equal to value of the entry. any person, any other person who causes the person referred to subsection 1 to make a false entry will also be liable. Some sort of abetment offense or what we call conspiracy. So if as an accountant, you have been party to the falsification of entry, it is no defense saying that 270A penalty will not apply. 271 AAD can apply. And this is old section 277 AA provided for prosecution. Now they translate into fiscal penalty also. And the amount of penalty is not equal to tax. It is equal to the amount in the entry. So this is a very dangerous provision. And I didn't know this, but then I checked up. My friend told me. Okay, thank you, sir. Okay. This is all we wanted to say. There's lots to talk about penalty, but it's not possible. Thank you. Namaskar. Anything else you want to say, Sridharan? You want to say something? You can add to the confusion. Thank you. The essence of the whole thing. Just show them slides. They won't ask questions. Yeah, that's for you. All right.
Any questions? Should we have anyone who will have questions, please? You may ask now.
Chitle sir, whatever errors I made, you can correct them.
No, sir, we are fine with your speech. It was, you have touched upon the salient features of this particular penalty and others. Thank you.
Sharmaji, any questions? Right. Any questions, anyone, please?
Sir, all clear.
All
Computer
clear.
language.
All right. So I think, sir, first of all, thank you very much that you've taken out time. I think when you said that, I believe Salman Khan and you both are, you have so many things in common. You have such a huge fan following. I mean, we reached out to you 3 months ago, and then, even we reached out to Salman Khan for any award show 3 months ago, but, constant follow-ups. But I think you are bogged down by so many calls that, it becomes difficult to track. And in half day, I think he gave a wonderful performance for one of the awards where I was also part of the organizing committee. And sir, you have done today, I think, despite being late, given you a short time and also given you, just half day to prepare today. Thankfully, we could reach out to your phone and, we confirmed that today's session for you. But brilliant. I think let's have a huge round of applause for Sridharan, sir. WRC, we try reaching out all the
Arpit. Mr. Arpit. Mr. Arpit.
When a lawyer is arguing, he is supposed to be called acting.
Acting.
Acting is never true.
And sir, I was
Acting is false.
False. And one of the
Arpit,
worst,
Arpit,
sir, Chitle sir.
See what we can say. We can invite this issues, queries, etc. within a week or 10 days time, and then we can pass on to Sridharan sir. Maybe we can get answers thereafter, because maybe spontaneously people might not ask.
Sir, noted. Right, sir. So I think very well put up, and some wonderful the kind of personalities that we have already invited. While you discuss, sir, I think that is the beauty when Palkhiwala ji is quoted, when Bansi Mehta sir is quoted, when so many others are quoted, and these beautiful words come out. I think that brings out the creativity in this entire wonderful, what looks like a very dull subject, a draconian subject, but it becomes beautiful with the taxation and everything. And somewhere I've heard how not to write. If you want to understand, please read the Income Tax Act. But sir, you have even made sure that this happens so very well. So thank you once again, and thank you, Sriram. I think I understand if sir has to face someone, the energy who gives is from you. So yes. So therefore, it's wonderful that you've been always on the side with sir, and that helps him to regularly deliver effectively. So with this, I end the technical session 1. Thank you, Chitle sir, for being around. And we'll look forward to hear from you very soon again. I request now, if you all are okay, should we continue with the next session immediately? Yeah, or do you want to take a break? Yeah, everyone, please. All right, so we break for 5 minutes. Please come back soon. We've got our next faculty, next speaker here, Yogesh sir, already with us. Welcome, Yogesh sir. And quickly, everything is arranged just outside. You can please have a quick nature's call break and tea or coffee. And please assemble as soon as you can so that we can start with our technical session too. Thank you very much. Sir, please.
Our speaker, and we have our Central Council member CA Mangesh Kinnare sir and our speaker CA Yogesh Thar sir. Hitesh sir, please escort our speakers and Central Council member. It is always important for all of us to attend refresher training courses, especially because things keep changing, especially for a subject like direct tax and one of the most important topic, direct tax refresher course. Redevelopment projects are an important topic these days, and discussing tax aspects on it, one of the most important one. We have our very own CCM, CA Mangesh Kinnare sir, along with us, and my RCM colleague, Chintan Patel sir, who has joined us online. I request our CCM, CA Mangesh Kinnare sir, to kindly address our participants.
Good evening, friends. Respected speaker for this second session of the Direct Tax Refresher course, CA Yogesh Thar ji. Regional Council Member Ridesh, other Regional Council members sitting here, including Secretary Shweta Jain, Arpit Kabra, Hitesh Pomal, Pinky Kedia. Speaker for the first session, Sridharan ji. Respected seniors and friends. Of course, online I am also seeing my Central Council colleague, senior Central Council colleague and Direct Tax Committee Chairman, CA Chitre sir, and Chintan Patel, a Regional Council member. Direct Tax Refresher course is a signature program of West India Regional Council. And every year, rather except for last couple of years, we have been organizing in the southern or central part of the Mumbai. This year, still, we are not out of that cloud of COVID. And that's why I think we have been organizing, WIRC has been organizing this program here. But I'm very happy to note that the registration or the interest of the members for this course is still the same. In fact, I was just talking before the start of the inaugural session to some members outside. And, you know, being here in WIRC since 2006, I know many of the faces in Direct Tax Refresher course are familiar faces. You know, they are regularly coming, religiously coming every year in Direct Tax Refresher course. Sharma ji hai hamare saath. And this course is something of, as I can say that it's a very important in a professional life of a Mumbai chartered accountant. Mumbai, when I'm talking Mumbai, it's a greater Mumbai, I can say. And regularly we see these faces and meet people every year. So in that sense, it's great to be meeting each one of you once again, year after year. And I'm pretty sure this course is looked upon by many people as really a refresher course. It's not only for the purpose of CPE that people are coming here. I know that, pretty sure. And here, even a regional council also takes a lot of efforts in every regional council for that matter to design the course and present before the members, because this is a kind of a program which is an identity of West India Regional Council. And this year also, I was just looking at the entire structure. It's been fantastically done. I congratulate Direct Tax Committee Chairman Hitesh Pomal ji, and of course WIRC Chairman Murtuzaji. I am also, I think I missed Sanjay Nikam, also regional council member who is present here. Friends, this session is on real estate redevelopment. Now, redevelopment, especially in Mumbai and surrounding area, has become a very, very important aspect as far as taxation as well as RERA is concerned. Now, seeing the city growing, redevelopment, its TDR, the issues which are faced by the tenants or the occupants, the primary occupants, are manifold. And the department's approach in treating the income in some way or the other, or the manner in which beneficial to the revenue, is really growing day by day. And therefore, the taxation aspect or the direct tax, now we are here in direct tax session, that's why I'm talking about direct tax. But entire taxation gamut, as far as this redevelopment projects, is something which has to be thought about in a holistic manner. Somewhere, something would like to do, and if suppose we try to plan something direct tax, and in GST something happens or RERA something happens, one has to look at this subject in a very holistic manner. Having said that, the direct tax, indirect tax itself, the issues are so many that at times redevelopment of project itself, it gives us what you can say, the professional assignment for year after year, even one project redevelopment. I think we are having an eminent faculty here to deal with this subject. Yogesh Bhai has been associated with in the WIRC sessions, especially DTRC also. I recollect that when I was chairman, I think in one session when I was chairman of WIRC, in that year also, DTRC one session Yogesh Bhai took. And to listen to him is a really treat, especially when the niceties of laws he takes out. And it's really a great learning for us. Definitely, I would not like to be in between your learnings. I can only tell you one thing which is not perhaps related to the subject. Two things rather than one thing, if I may take a little bit freedom. One, of course, I think it might have been talked about by the chairman, the president of institute in the afternoon regarding the CRET, the new curriculum. Please give your suggestions, which is very important for our profession at large. Second, as far as taxation is concerned, and my committee, I'm a chairman of Ethical Standard Board of Institute of Chartered Accountants of India. And one direct subject relating to direct tax is coming before Ethical Standard Board. Rather, these provisions have been deferred, and will be taking the decision soon. That is regarding taxation services by auditors. When we are a statutory auditors or a tax auditors, what kind of a taxation service we can give? Whether we can give a return filing, of course, return filing is allowed, but especially there is a issue regarding the representing the clients in terms of the international code. And if we have to adopt that international code in India, there is an issue, and we are tackling those issues. So I can appeal you from this forum to help me in this regard and giving suggestion. You can go through the provisions of Code of Ethics, which have been deferred, taxation services provision. And we are going to implement it from September onwards. So in that sense, in that regard, if you can just give the suggestions to Ethical Standard Board on esb@ici.in, I will be much more grateful to you, because we have to take decision, and definitely as a Ethical Standard Board, we would like to stick to the Code of Ethics, International Code of Ethics, implement that International Code of Ethics, keeping the mind the practices followed in India, and taking in the mind the interest of the tax professionals also, audit and tax professionals also. So I would request you to go through these provisions from Code of Ethics. It is there in volume 1 of Code of Ethics, and give your suggestion in that regard. I am not an expert to talk on the current redevelopment subject, so I would prefer to listen more to that subject from Yogesh Bhai. Thank you very much, Western India Regional Council, for giving me this opportunity to present my views in front of this August gathering. Thanks a lot. Happy learning.
Thank you so much, Mangesh sir, for your kind address. Now I request CA Chintan Patel, Regional Council Member, to kindly introduce our faculty for today. Over to you, Chintan sir.
Thank you so much, Radesh. Good evening, everyone. Not taking much time, I understand that one of the most important topic and the time is short. The faculty himself, I think, is very, very well-known and experienced person, having experience more than 38 years. And he has acquired specialization in the area of corporate taxation, taxation of non-residents and foreign companies, business mergers, acquisition, and restructuring. He is a partner of Mrs. Bansi as Mehta and Company, a leading CA firm in Mumbai, and he is a fellow member of ICAI. He is also has in his credentials authorship of various books and articles on direct tax and double taxation evidence agreements published by mainly taxmen, the Chamber of Income Tax Consultants, and by Bombay Chartered Accountants Society. He has been visiting faculty of Nursing Munji Institute of Management Studies and has served as member of committee constituted by Honorable Bombay High Court in 2014. Presently, he is a member of Taxation Committee of Chamber of Tax Consultants. With this brief words, I welcome sir to this August dais and one of the most important topic of redevelopment taxation. Thank you so much.
I request CCM sir to kindly present the memento to our speaker.
Thank you. Central Council members, Mr. Mangesh, Mr. Radesh, other council members, the speaker for the earlier session, Shri Sridharan Sahab, seniors in the profession, ladies and gentlemen. Yeah, Mangesh rightly said, DTRC has been a hallmark of the WIRC, and tax professionals do wait for it, and I see myself seated on that side for many, many years. And it's from here that we have learned so many things. The topic for the day allotted to me is really tax implications on redevelopment projects for the existing societies, flat owners and developers. This is what Mr. Mangesh mentioned, with a focus on city of Mumbai, issues concerning development projects, redevelopment projects of societies is something that needs a little more focus. We have had a few sessions in the past, I remember, on the development projects in general. We have had sessions on 45(5)(a) when it came, but with a focus of development, redevelopment projects of societies. I think it was really required for one to study it carefully, see what is the current practice which is going on, to what extent that practice is right, to what extent that practice is being followed as a herd mentality. Sab log karta hai to hum bhi karega. So first of all, thank you, WIRC, to give this opportunity to me to really revisit this issue or issues concerning redevelopment of societies and the taxation of members, etc. And I got a chance to review, the provisions, review the practices which are going on, and maybe at the end of the session, I don't know whether you will be all more enlightened or more confused as to what is the correct position or what is the correct taxation position that one should be taking. But I'll be presenting, what I'll be presenting are my views on the subject, and I'll try to substantiate the said views. So let's get into the subject proper, friends. Society redevelopment projects, and what is the commercial rationale for, what is a commercial rationale for such development, redevelopment projects? Typically, we have old buildings, not in very good conditions, and therefore it is something which needs extensive repairs. Members are not willing to, shell out funds. Maybe they have funds, they do not have funds, but everyone, and there's always a problem when it comes to societies. There'll be someone who will say that, no, I'm not willing to shell out funds. And therefore, redevelopment becomes a problem. So, therefore, there's a way out which has been found out, the way out which has been worked out by everyone, including municipal corporation, about 15, 20 years back. And what really happens is that the redevelopment project is given to a builder, a developer. That developer introduces funds. He develops it at his own costs, and therefore the society or the members do not have to shell out any funds. And members of the society are given some additional area as compared to what they presently occupy. And also they are given some cash compensation. And this really acts as a catalyst to incentivize the members to, actually pass resolution in favor of the redevelopment projects. Otherwise, one would say that mere ko kya milta hai? Why should I get into it? I will not pass resolution, and jahan baithe acha hai. So therefore, that's this incentivization it acts as a catalyst, and therefore it really works. And so members get something, at times society gets something, and developer is permitted to construct an additional area which he can then sell and earn money out of it. So this is how this redevelopment projects in buildings owned by societies, housing societies, work in the city of Mumbai. Now a question arises, how is this additional construction made possible? Because there was already a plot of land on which a building was constructed. Whenever it was constructed, the builder at that time would have utilized the entire FSI. So how come an additional area can be constructed? Because if you reconstruct, the same people will come and stay there. So how is an additional area possible? How is that man, the developer, going to get an additional area? So the answer to that really is that this additional FSI is available in a couple of ways. One is, there are instances where there are road widening projects of the municipal corporation. So you have a building and you have a compound, and you are told that the road outside has to be widened so that compound wall is taken inside. And therefore there's a strip of land which was earlier belonging to you, now goes to the municipal corporation. It is converted into a road, and therefore that road outside is widened. So when that strip of land is taken away by the corporation allows the society to use that much area to do some construction, which is popularly known as setback FSI. So that is one way in which I get, or the society gets, an additional potential to construct a little more than the existing, structure which it has. Second, and the more important one, is the change in DC regulations in 1991, when this entire thing was really conceived by the corporation, which really made these redevelopment projects possible in the city of Mumbai, where the earlier rules of FSI, the permissible limits up to which one can actually construct on a plot of land, those limits were actually increased. Or in other words, the restriction were reduced, that you cannot construct more than a particular level. Now you are able to construct more than those old limits. And those regulations having been changed, all of a sudden the construction potential or the development potential of the plot increased at that point of time. That coupled with the concept of TDR, to say that, all right, there is a land, TDR actually is what? It's transferable development rights. What it means is that a person is owning a particular plot of land somewhere in the city of Mumbai, and he is surrendering that plot of land to the corporation for the purposes of public good, like parks, etc. And that land which he surrenders, in consideration of that person receives what is known as a transferable development right. And that development right he can use to make additional construction anywhere towards the north of the city of Mumbai. And that certificate is a valuable certificate for him, which either he can trade it, sell it to somebody else, some builder who would like to do the construction, or that person may himself utilize to construct somewhere towards the. So when this development potential in 1991 DC development regulations were changed, that the additional potential of development on a given plot were increased, subject to a condition, most of the time subject to a condition that the builder would also get in TDR, so that there is some plot which is being converted into a public park or a public space or something good for the public, and that potential you utilize over here and construct. So, so that is how it happens. And then in the recent past, the concept of fungible FSI, premium FSI was introduced, that if you want to construct more than the potential of the plot, then the builder has to give pay extra premium to the corporation, buy some rights to construct, and he can construct. So this is how the additional potential of a plot comes into existence in case of an existing building. So this acts as a win-win situation for everyone. It is good for the members because their old buildings will get reconstructed into new. They will get new flats, they will get additional area, they may get some cash compensation. It is good for the members and therefore for the society as a whole. It is good for the developer because he gets his business opportunities, and it's good for the municipal corporation because it gets money by sale of these FSI, premium FSI, etc. It gets to it gets to develop parks, etc., which are places for good, public good. And then there is yet another variety of such projects in the city of Mumbai, which is slum redevelopment projects, where you have societies of slum dwellers, and there is an agreement with a developer to demolish the slum hutments and construct the flats in buildings for rehabilitation of the slum dwellers. And then that developer also gets certain additional area to which is known as the free sale area, and so he can construct that building and then sell it on its own. So, so this is another variety of the development projects that happen in the city of Mumbai, and this is how it happens. Typically, if you look at very broadly, the normal broad documentation which is there, the key ones are the resolutions which are passed by the members of the society, and under the Societies Act, there are some provisions pursuant to which the government has issued certain circulars to say that 51% of the majority of the members of the society, if they pass for a redevelopment project, the redevelopment project can happen. Earlier it used to be more 70 or something, now it's 51. So that is resolutions of the society that becomes the starting point for the whole, for the project, which then gets into negotiation with the builder. You enter into development agreement with the builder. And the development agreement is therefore typically signed by the society, by the members of the society, and by the developer. Then each person would ultimately, each member of the society would ultimately get another flat to live in, which is a permanent alternate accommodation, and therefore there's another document which really gives a title to that man, to that new flat, which is known as permanent alternate accommodation agreement. And so that is another thing. And then lastly, you have got sale deeds, which the builder will enter into with the new buyers for his area, his free sale area, what he's entitled to sell. So these are broadly the documents. And what is to be noted here is there's going to be no conveyance, obviously, because the conveyance has already been executed by the original builder in favor of the society. And therefore the society is the legal owner. There is no further conveyance to anybody. And society is a legal owner and will continue to be the legal owner of this particular plot of land in a redevelopment project of a society. What is the popular structure of the transaction and its taxation? Let us first get into it. Most of us would have somewhere or the other touched this. So let's quickly look at how the structuring and the taxation is generally happening in the city of Mumbai on this issue. One is the developer agrees to compensate the members by offering additional area in the new flat as compared to the present floor area. Then there's a cash compensation as a lump sum, and there's a cash compensation on a periodic basis. The lump sum cash compensation is often structured as hardship allowance, and the periodic compensation is often structured as rent compensation. Why? Because the member during the construction period, once he gives the possession of his flat, allows the builder to demolish it and construct a new one. During that period, he will have to go and stay somewhere, and therefore he might have to pay rent where he goes somewhere, and therefore the builder gives him a rent compensation. So this is how the cash element and the additional area element is embedded in the entire compensation structure. At times you find the cash paid even to the societies. It is paid by way of corpus. They call it corpus. And what it really means is that what is corpus, it becomes a part of the corpus of society, and it will belong to the old members. What really this corpus is, we will see a little later. Then there is an additional one more category of corpus, which they say that, okay, the new people who are going to come in, the people to whom the builder is going to sell, they will come in, they will also introduce corpus in the society, and so as to equalize the corpus between all the members, because there will be old corpus, new corpus, and all the new members are there. So put all the members together, and therefore that corpus should be equalized, and therefore the new members, the new buyers will also get in. So this is how the compensation happens to the society as well. Now, how is this generally being taxed? Presently, what is the present system in which people are taxing it, tax department accepting, not accepting, what is happening? Let's just have a quick overview of that. In the hands of members, so far as the hardship compensation is concerned, you have number of decisions to say that this is a capital receipt, not chargeable to tax. This is based on a fundamental principle that any compensation which is meant for a personal injury is something which is not in the nature of income, and therefore it is not chargeable to tax. So like if you get any compensation towards your, say for example, your insurance claim, is it income? Answer is no, because it is for personal injury. So this hardship compensation which was coined sometimes, I think 15, 20 years back, in the initial years when these development projects were happening, mind well, there was no demolition of the existing building. The existing building was there, and then they used to take pillars on the side of the existing building and construct additional floors on the top. This is how in the initial 5-7 years of the redevelopment which happened in the city of Mumbai, the development projects happened. And then sometimes in 2004 or 2005, that system got stopped. And then we were told that you have to compulsorily demolish the buildings and construct the new ones. So hardship was really coined at that point of time, that when the people who are living there and a development project is going on, they will have to really undergo hardship. Because for a period of 2 or 3 years, there'll be dham, which will be happening outside the house. And there'll be all sorts of dirt and mud and whatnot, which will happening. People who are actually coming and going may fall down, they may slip, many things can happen. So there were actual genuine hardship. Because the construction work going on, you would find cracks in somebody's house happening and there'll be complaints here and there. So innumerable instances of hardship were there. And this is how the compensating a member towards all these hardship, that concept was coined at that point of time. That concept continues even today, that although a person is not living there, he gets displaced to some other place. And therefore that displacement itself is an hardship, that, he has to go somewhere else and stay. And therefore, his usual life, whatever he lives at a particular place, he is forced to go somewhere, and therefore that causes hardship. So the concept was coined at that point of time. It was intense. It had a lot of substance. It is continuing today. And still, I would say that it does have some substance. So then you have those, so that hardship compensation, capital receipt not chargeable to tax, more or less the tribunal benches have been unanimous on this particular issue, at least so far. Then this periodic compensation, which is received from the developer as rent compensation, and that is for practical purposes, that is also hardship, because I have to displace somewhere. I'm getting displaced somewhere. That hardship compensation in the form of rent is, the rent is really nothing but a hardship compensation. However, the tax department, I have found treating it in different manner. I have found some officers taxing it as rental income. Some officers treating it as income from other sources. I also found some SSEs succeeding in getting a claim of deduction of the rent which they pay against income from other sources, which to my mind is absolutely incorrect. You tax that rental receipt, that rent compensation as income from other sources, and from there you claim a deduction of the rent that you actually pay and claim it as a deduction. Now, to my mind, that's absolutely wrong, because under section 56, if you tax something, under section 57, what you are allowed is expenditure incurred to earn that income. This is not an expenditure incurred to earn that income. This is an expenditure which is earned out of that income. So anyway, so these various different practices are happening. You find that the builders would deduct TDS on this rent as 194I. Nowadays, things have changed a little, but under 194I, they used to deduct tax as rent. This is actually not rent. The builder is not paying you for using your premises. And therefore, this is not in the nature of rent. It is only compensating you for rent. You may or may not actually pay rent. So it may not be really a compensation, but it is a mode of calculation of compensation. So anyway, so this is a present practice. We'll come to the specifics a little later. So far as the flats is concerned, giving away the possession of the old flat and getting the new flat is treated as if it's an exchange. And therefore, claims are made that, okay, I have given away the old flat, I'm getting a new flat. So giving away the old flat, there's the taxing event which is happening. There is a capital gains on that, but I am sort of reinvesting in a new flat, and therefore I claim a exemption under section 54. And therefore, although there is a taxing event, although there's a gain, I claim exemption under 54, and virtually I don't pay any tax except for the cash compensation element that I may end up paying tax. So there is, unless this cash compensation is by way of hardship, I don't pay tax also over there. So this is also one of the practice which is going on. And now you have section 45(5)(a) in the Income Tax Act, and in some cases, members who are individuals to whom 45(5)(a) would apply. They offer this capital gains as income under 45(5)(a) in the year in which the completion certificate is received. And against that, you claim section 54 exemption, and that's it. So this is the overview of the present practice which is going on. To what extent I agree to it, I do not agree to it, we'll come to it a little later. So far as societies are concerned, whatever is received by the societies have argued and successfully right up to Bombay High Court that society is receiving something towards this transfer of development rights, and these development rights, which as I said, which really accrued as a result of the change in development control regulations in 1991, do not have any cost of acquisition, and therefore, in absence of cost of acquisition, apply BC Srinivas Shetty, and therefore there is no capital gains tax payable. So based on that, societies have been taking a position that there is no taxability in the hands of the society because it is transfer of development rights which do not have any cost of acquisition. And you have Bombay Tribunal, Bombay High Court on this particular issues, followed in many, many decisions. I'll be discussing all these in a little bit of greater detail a little later. Now, having seen what is the present practice, how the transactions are structured, let us go to the basics. What is a development agreement? We find this discussion in the decision of the Supreme Court, where the question, interestingly, the question was under the Consumer Protection Act, where the question was whether a landowner who enters into an agreement with a builder for construction of an apartment building and for sharing of the constructed area is a consumer entitled to maintain a complaint against the builder as a service provider under the Consumer Protection Act. So this was a question before the Supreme Court. And in deciding that, it ultimately decided that yes, the builder is a service provider to the extent the owner asks him to construct the flat for himself, for the owner. To that extent, he is a service provider. That is what they held. But in doing so, they've actually discussed what is the true nature of a development agreement. And let's go through that. Appellant is the owner of the land. This is, I'm quoting from Supreme Court. The appellant is the owner of the land. He wants a new house, but is not able to construct. He therefore enters into an agreement with the builder. He asks the builder to construct a house and give it to him. I'll pause here for a moment. So if I am a owner of a house and I ask a builder to construct a house and give it to me, it's a contract. And therefore that builder really is a contractor who is working for me to build a house for me. Now, he says that as he does not have money to pay for the construction and will therefore permit the builder to construct and own additional floors as consideration. So he constructs for me as a contractor. Supreme Court doesn't use the word, I'm using the word so that we understand the concept. And I pay him. In what manner? I pay him by allowing him to construct additional floors which he will own and he can sell. So that is the consideration which I pay him for constructing for me. This is a concept. Then it further says he also agrees to transfer an undivided share in the land corresponding to the additional floors which falls to the share of the builder. As a result, instead of being a full owner of the land with an old building, he becomes co-owner of the land with a share in the land and an absolute owner of certain constructed area of the newly constructed building, and agrees that the builder will become the owner of the balance area with corresponding share of land. So at the end of the day, that 100% owner becomes a 50% owner or a 60% owner, and the builder becomes the balance owner, and both of them own their respective constructed area and their respective land or share in the land. Then it goes further to say, as the cost of the undivided share in the land, which the landowner agrees to transfer to the builder, is more than the cost of construction of the area by the builder for the landowner, it is also mutually agreed that the builder will pay the landowner certain additional cash consideration. So I need to equalize what I'm giving to the builder and what I'm getting from him. I need to equalize that. If it doesn't equalize, then the builder adds a little bit of cash compensation to it and equalizes it. So what I am transferring to the builder should be equal to what I am getting by way of cost of construction for me, plus the cash that he gives me. This is the theory. Okay. Then it goes on to say that the basic underlying purpose of the agreement is the construction of a house or an apartment in accordance with the specifications by the builder for the owner. The consideration for such construction being the transfer of undivided share in land to the builder and grant of permission to the builder to construct additional area. Such agreement is a contract for construction of an apartment or house for the owner. I repeat, such agreement is a contract for construction of an apartment or house for the owner in accordance with the specification and in the terms of the contract. There is a consideration for such construction flowing from the landowner to the builder in the form of sale of an undivided share in the land and permission to construct and own the upper floors. To adjust the value to the of the extent of the land to be transferred, there is also payment of cash consideration by the builder. But the important aspect is the availment of service of the builder by the landowner for a house construction, construction of owner's share of the building for a consideration. To that extent, the landowner is a consumer, the builder is a service provider. So this was the decision. And in coming to this decision, this entire concept has been explained to us. And therefore, this is now in front of us, where as an accountant, I will just to summarize this, that X is equal to Y plus Z. What is X? What is the owner transferring to the builder? He's transferring the builder's share in the undivided portion, undivided share in this land. That is X. Is equal to Y plus Z. What is Y? What is the cost of construction that the builder is incurring for me, for my area? Plus Z. What is Z? Cash. What the builder is giving me. So this is how the concept is explained. And let us move forward on this basis. Yeah. This is not a tax matter. So because, yeah, so because it's, no, that's right. But in the process of explaining the consumer law, they have explained what is this development agreement, and which will help us in understanding and coming to drawing some conclusions for tax purposes as to how it should be considered. Is there a transfer of an intangible asset? Is there a transfer? No transfer. Yeah. Okay. So now let's move forward from here. That commercially, what is the gain for both the parties? You have a landowner and you have a builder. What does the landowner give to the builder? Let's consider that this agreement is 60-40, where 60 is the builder's rights and 60 is the builder's share and 40 is the owner's share. Okay. Then what is the landowner agreeing? As per this decision of Supreme Court, the landowner is agreeing to give conveyance of 60% of undivided interest in the land to the builder. And what is builder agreeing? He is going to construct 40% of the constructed area, which is for me. He's going to construct 100%, but 40% is for me, the landowner, plus he's going to give cash. So what is the gain to the landowner? Although here it's capital gain and indexation and all those words are used, it is just a commercial way of looking at it. Keep the tax laws aside for the time being. Commercial way of looking at it. What does the landowner get? He gets the cost of construction of 40% area. Because if he had not appointed the builder, he would have to spend it himself to construct that area for himself. So he gets cost of construction of 40% area, plus he gets cash. And what does he give up? He gives up 60% undivided interest in the land. And therefore, what is his gain? The gain is what he gets minus the cost of his 60% area, and that is his gain. That is his commercial gain. What does a builder get? Obviously, he gets a sale proceeds of the 60% area which he has constructed when he will sell it. And what does he incur? He incurs the cost of construction of the 100%. And that is the difference, is his profit. Clear so far? Now, let us apply this decision of Supreme Court to a case of a society. Supreme Court said, I'll just repeat this, quickly read it. Appellant is the owner of the land. Yes, society is the owner of land. He wants a new house, but is not able to construct. Yes, society or the members are not able to construct. He therefore enters into an agreement with the builder. Yes, he enters into agreement with developer. He asks the builder to construct a house and give it to him. That's right. He says that as he does not have money to pay for the construction, and he will therefore permit the builder to construct and own additional floors as consideration. Exactly. So far, it matches with all your development agreement that the society enters into, or a landowner other than a society entering into with a developer. It matches so far. Let's go further. Then Supreme Court said he also agrees to transfer an undivided share in the land corresponding to the additional floors which falls to the share of the builder. This aspect is missing so far as society is concerned. Because society does not transfer any undivided interest in the land to the builder. Society was the owner, it continues to remain the owner of the land. No rights of the members, in fact, no rights of the members are also getting reduced. In fact, the members may be entitled to a little larger area, as we just saw. And the members may be entitled to more facilities if the builder is providing facilities like gym and swimming pool in that new building. So that is quite possible. So therefore, member is gaining something. Society remains the legal owner of the plot. There is not a square feet of a plot which is conveyed in favor of anybody else. And therefore, this part that he also agrees to transfer the undivided share in the land corresponding to additional floors is not met in the case of societies. Then next one. As a result, instead of being a full owner of the land with an old building, he becomes co-owner of the land with a share in the land and absolute owner of certain constructed area of a newly constructed building, and agrees that the builder will become the owner of the balance area. This is also not happening because builder gets right to construct and sell the additional areas. His buyers get membership in the society. Nobody becomes the co-owner of the land. Society continues to be the sole owner. So this part of the decision of Supreme Court is also once again not met. So there is no transfer of any land involved in the transaction of development agreement when it comes to society cases. Unlike in the case of landowner versus builder, where there is a transfer of certain undivided interest to somebody. In the case of a society, that aspect is missing. And therefore the question arises, friends, what is getting transferred in case of society redevelopment projects? Is the members transferring their flats? Is the society giving away anything? No, as we saw, members are in fact going to get something more. What is the transfer? The answer to my mind is that it is the development potential of land which is getting transferred. Because if the development potential was not there, this developer will not come in and I will have no contract. He's not going to pay me anything. He's paying me only because of the development potential, which is either come in because of 1991 regulations or because of your setback FSI or whatever TDR. So he's paying me because of, so that is getting transferred. Now, I learned something new yesterday from my dear friend Jagdish sitting over here. I asked him, how does stamp duty authorities look at it? How do development agreements get stamped? And I got the information that they look at it in two ways. One, what is the builder giving away and what is the builder getting? And the higher of the two becomes the base for charging of stamp duty. So what is the builder giving? Builder is giving the cash which is payable to the society or the members, whichever way it is. Whether hardship you call it corpus, whatever you call it, under that agreement, that cash is being paid. either to the members or to the society. Plus the cost of construction is what the builder is giving. What is he getting? He is getting the development potential of the free sale area. So whatever he will be eligible to sell, that development potential of the free sale area is what he is getting. And that is being valued by the stamp authorities. And an interesting information here also is that in the city of Mumbai, the practice is that is valued at some 65% of the underlying land value. And why 65%? It's probably because the builder will have to load the TDR. Otherwise, he will not be able to construct. So to that extent, 35% would be probably the value of the TDR that he has to get in. And therefore, 65% of the development of the underlying land is the value of the development potential. Now, so therefore, the higher of the two amounts will become the base for stamp duty purposes. Thus, yeah.
Higher of the two is always taken.
Possible.
Tax is on instrument.
Yeah.
Tax is on instrument.
Correct.
Tax is not on the transaction. If you transfer a TV for a laptop, tax should be higher of the two value.
Tax.
Taxation itself provides for that.
Right. Okay. That may be the basis.
There's no magic in it. Higher of the two is because it's an exchange. On exchange, stamp duty is tax on instrument, not on the transaction. The higher of the two value, that's what the entry provides. Perfect.
Yeah, I'll come to it a little later, whether it's an exchange or not. Okay. Correct. Stamp authority. Correct. Okay. Right. Now, so therefore, what is transferred? Development potential is transferred. No land is transferred here. Development potential is transferred. Where does this development potential come from? Road cutting FSI or the change in the DC regulations that we just saw. Question now is, who is transferring this development potential? Is the society transferring, or are the members transferring, or are both transferring? If you look at all our tax case laws, you don't find answer to that because you have case laws of all varieties. You have cases where society receives something and where the fight is that this is received because of DC regulation 1991, no cost of acquisition, no tax. One line of decisions. Other line of decisions, members have received hardship compensation, capital receipt, no tax. Third line of decision, that members have received something and the department wanted to tax the society. Department aggregated every rupee that every member got, and that aggregate was taxed in the hands of the society. Why? Because legal owner is a society, and therefore this income actually belongs to the society. And you have Bombay High Court saying that when members have received something, society cannot be taxed. So you have these variety of decisions. These decisions are fine, but the point is, if I go to the basics to understand the basic, who is transferring the development rights? I don't know whether the member is transferring or the society is transferring or who is transferring. Unlike in a condominium, where every apartment owner has an undivided interest in the underlying land, in case of a society, that is not so. In the society, the undivided interest in underlying land is not really there with the member. Society continues to be the legal owner, and the member occupies that house by virtue of his being a member and a shareholder of the society. That is the form of this transaction of a member of a society. But when you come to substance immediately, you look at the stamp law, you look at the ready reckoner value of a flat, it is independent of whether it is a society or whether it's a condominium or whether a person is the owner. There's a one stamp duty value. So the fair market value as conceptualized by the government is one for everybody. Whether he's a member of a condominium, whether he's a member of a society, whether he's a landowner himself, does not matter. So substance, it doesn't matter, because even if he's a member of a society, the value of the underlying land is embedded in the value of the flat, which they feel is the per square feet area, a per square feet rate. Go to the CBDT circular of 1969. And they said for all purposes, of course, the circular was for a different purpose, but they said for all purposes, including attachment and recovery of tax, the individual member should be regarded as the legal owner of the property in question. Here they were concerned with attachment and taxability of the flat owned by a member. And the question was that society is a legal owner and how do I do it? And the CBDT said that forget everything, you consider the member as the legal owner. So go to the substance of the matter. 27.3, you have a deeming provision, which says that a member of a society will be deemed to be the owner, and therefore he will be chargeable to tax under income from house property. Again, what is society? The builder has sold the flats to every buyer, then those buyers form a society. That is the normal thing in Mumbai. I am aware about the other type of societies. We are not really concerned with that right now. So the builder has sold to the buyer the flats, and therefore he has sold the underlying land also to them. Then that land is conveyed to the society without any further consideration, and that consideration is all embedded in what he has charged to the flat owner. So that conveyance is happening only because he has taken a commitment under the agreement that he will convey in favor of a society which the members will form. So again, coming to the substance, although the conveyance is in the name of the society, who is a real owner, it seems it's a member. So society is merely a representative of the individual members. If you look at the valuation of the flat, valuation of flat will factor in all the benefits attached to all the common areas, and therefore commercially the real owner of the entire property are the members, though the legal owner is a society. Looking at it from a slightly different angle, societies, housing societies are taxed as mutual associations, because any surplus remaining out of the contribution of the members is not taxed in the hands of the society. Why? Because it's considered as a mutual association. I cannot make profit out of myself. That surplus is never taxed. If there's a deficit, it is not allowed as a loss carry forward or something like that. So once again, in practice, so far as tax practice is concerned, the fact that it's treated like a club, it's treated like a mutual association, there is no real distinction between the society and the members as such. However, if the society receives some income from outside, it will obviously be taxed in the hands of the society. Now, consider the Bombay High Court decision in the case of Raj Ratan Palace, where I said that the third type of decisions I just mentioned, where the members received, the cash compensation from the developer, and the tax department aggregated everything and taxed it in the hands of the society. And the Bombay High Court says, no, it can't. Once the members have received, it can't be taxed in the hands of the society. Whether members will be taxed or not is a different issue. That was not subject matter of issue before the High Court. With all this, I have drawn my conclusions as to who is the transferor in this case and in whose hands the income should be taxed, can be taxed. I would feel that members have a power of disposal by passing appropriate resolutions. If the members pass a resolution that the consideration is to be received by the society, the consideration will be received by the society, it will be taxed in their hands. If they pass a resolution that the consideration should come to the members, then you may have to invoke the concept of diversion by overriding title, and it will be the members who would be taxed because the income has never gone to the society before coming to the members. It is diverted by an overriding title because of the resolution of the members. To some extent, it is akin to cases of mergers, demergers, where the consideration goes by way of issuance of shares to the shareholders. In case of societies, you are much, much better off as compared to the case of companies, because company is not a mutual association. Here, society is a mutual association. In a company, a shareholder is not the beneficial owner of the property, whereas society being a mutual association, to my mind, a member of a society may not be a legal owner, but he has a beneficial interest in the assets of the society. So the legal transfer is society, but real transfer is the member. Consideration accruing or arising to either society or the members, depending upon what the members decide in their general meeting, will determine who is the earner of income and in whose hand it should be taxed. The tax department cannot rewrite that agreement because what is a commercial agreement, what is decided by the members, because if you say that members pass a resolution on the basis that members have to receive, department cannot rewrite to say no, it is actually received by the company and then by the society, and society has given it back to the members. It cannot rewrite this because such an agreement would be hypothetical situation. If this were to happen, it would not have happened. If you say that the money will go to the society, the members would not even pass that resolution. So therefore, one will have to go to the root as to how the members have dealt with it. It being a mutual association, they have decided to do it in a particular manner, and therefore the tax consequences should follow in that manner. So therefore, who is the transferor of the development rights? To my mind, the transferor can be the society, the transferor can be the members of the society, depending upon how the members decide to deal with it, especially because you have to look at the theory of real owner versus legal owner. You have to look at the fact that society is a mutual association, unlike in case of companies. Having said that, what is the nature of the consideration? As we saw, consideration is structured in various ways: hardship, corpus, etc., etc. But what is the true nature of this consideration? In substance, I would feel that the consideration is for transfer of development potential. Because if that development potential was not there, the deal would never happen. So there is a consideration for transfer of development potential. Now, will I be able to justify something as hardship compensation or no? I would feel that if a society is conscious of structuring the transaction or a deal in a manner that you look at, as I said earlier, you look at the stamp duty law, how they are looking at it. Development potential multiplied by the underlying land rate at 65% is one part. The other part is what is the consideration flowing. Now, if you say that the consideration is more than that stamp duty value of the development potential, to that extent, you can say that that was because of the hard bargaining of the members, and that can just get justified as hardship compensation. So consideration in excess of the stamp duty value of the development potential would, to my mind, certainly stand a test of hardship compensation. But if you do something different, if everything is structured as hardship compensation, then I'm not sure in some case someday there'll be an issue that really a compensation for transfer of development rights is structured as hardship compensation, and therefore we don't agree that this is not chargeable to tax at all. So when we are dealing with planning a particular project, I would feel that this is a way in which one should really go about. Rent, once again, is what? Rent, once again, is in the nature of hardship compensation because you are getting displaced during the period of construction, and that hardship is there. And so the mode of computation of compensation does not determine the nature of compensation. You have I don't remember this 46 ITR, one decision is there in Supreme Court. I forgot to write the name. Sriram Dongal. Seni Ram Dongal. Perfect. Perfect. Absolutely. Wonderful. Thank you, sir. Thank you so much. So the character of a receipt cannot be determined based on how it is computed. That similarly, corpus is nothing but consideration for transfer of development potential. Merely when you call it corpus, it does not become a capital receipt that will sit in the capital account. It will sit as a corpus in the balance sheet of the society. Therefore, it's a capital receipt. I think it's a very simplistic view of the matter, and according to me, that's not right. And therefore, what popular practice which we just saw? There should have been a question mark over here. The popular practice which we just saw, is it really right? Or is it something which needs to be relooked or properly planned when you're sitting for planning a new project? That takes us to 50C, whether 50C applies to development agreements or not. You have decisions both sides that 50C, one is the line of decisions which say that 50C applies to a capital asset being land or building or both, and development rights are merely rights in land or building. They are not land or building by themselves. And you look at the provisions which are contained in chapter 20A, the 20A dealt with separately with land and building and rights in land and building. And therefore, whenever the legislature wanted to consider both, they've considered both separately. Here in this section, they have very clearly said capital asset being land or building will only include land and building and not interest in land and building. There's one line of decisions, and therefore 50C does not apply to development agreements. The other line of decisions, contrary to that, and they've taken a view that development rights would also tantamount to land or building. Transfer of any development rights would be regarded as covered under section 50C. Now, having said that, in the context of society, what is the position? I would feel that in the context of the owner-developer type of a situation which we saw in that Supreme Court decision, there is a transfer of land ultimately happening. In the case of society, it is never going to happen. So in the context of society where there is no ultimate conveyance of land or building at all, section 50C should have no applicability according to me. A mere development potential not followed by transfer of undivided interest in land should not come within the purview of 50C. That's my view on the subject. And as I said, even the stamp authorities as a practice consider merely 65% of the full land value for computing stamp duty on development agreement. Thus, even the stamp duty authorities do not consider the development agreement as land, but something lesser than that. In cases where the AO has applied 50C, so you have cases where assessing officer would apply 50C. If you're lucky enough to get it through, fine. But if you're not lucky enough, then what are the sort of arguments you need to take? You need to take alternative arguments that you please consider not beyond 65% of the value. Secondly, and more importantly, you consider what is the consideration for that development rights in totality. What is received by the society, what is received by the member, aggregate it with the construction cost, and then you take a view. You can't take a view only based on the cash compensation which is received either by the society or by the member. And therefore, if you aggregate everything, in all probabilities, you will be through, because the commercial deal will always happen in a manner that the aggregate of the consideration which flows, to the members and the society would be more than the stamp duty value. So that was 50C. Now, what is the cost of acquisition of development potential? First, what is the cost of acquisition of that road cutting FSI which we just spoke about in the beginning? That cost is embedded in the cost of the land, which is conveyed by the builder to the society in the past. The question is how to compute that cost, as the cost is paid by each buyer and not by the society. There could be two views in the matter. Aggregate of the cost paid by the original buyers to the builder. You aggregate it and then apportion on some rational basis that for that strip, what is the cost, and that is the cost. Second, you say there's no cost of acquisition. Because society has not paid anything for it. There's no cost of acquisition of that strip of land which is surrendered, and therefore there can be no charge to tax. To my mind, so far as this aspect is concerned, view one seems to be a better view, because cost was indeed paid by the members. Conveyance was executed in favor of the society by the builder based only on its commitment in the agreement with the flat buyers. Society, therefore, is a mere representative of the members. It's a legal owner. Real owners are the members. If the tax department taxes every member on a proportionate basis, such assessment may ultimately be upheld. So I think in a case like this, to say or apply no cost theory may not succeed. CBTT circular, I referred to that. Section 27(3), I referred to that. And based on the above, the reasonable view is that the cost of acquisition of the land acquired in a road widening scheme, and hence no cost theory may not be applicable. Then, so that is one. Then when does the income accrue in the hands of the society in case of receipt of FSI under a road widening? That's all right, that's done. So when does the income accrue? It accrues at the time when the compensation in the form of FSI or a TDR certificate is received upon surrendering of the land. And the second view is when the FSI is actually transferred to the developer. So if you look at 45(5), which says that in case of compulsory acquisition, the taxability is not at the time of transfer. So when I'm actually surrendering, that's not the time, but when I'm receiving the compensation, that is the time at which the capital gains gets triggered. So the question is that I receive FSI or I receive the TDR for construction of additional space by virtue of surrendering that strip of land. Does it become taxable upfront? So based on 45(5), one will say that when I'm receiving, it becomes taxable. But we think a little bit in detail about it. Then you find that Supreme Court in Excel Industries was confronted with a situation where export incentives were given to a person who would export. And that export incentive was in the form of duty-free imports to be made at a later date. So when a person exports, he's entitled to some import entitlements. Question was, does it become income at that stage? Or it becomes income only when I ultimately use it to make a duty-free import? Supreme Court said that accrual happens at a later stage because accrual presupposes not only that you have earned that income, I have exported and therefore earned that income, that is fine. But there should also be a liability on the other side to pay you. So they said that there's no liability of allowing you to import without payment of customs duty until and unless you actually import. And therefore they said that that liability of the government comes in only at a later stage. You apply this principle, then I would feel that even in case of this TDR, which is given to me on the surrender of land, it becomes taxable only at the time when I actually use it or I sell it to the developer. So view 2 seems to be the better view in the light of the decision of Supreme Court. Then what is the cost of acquisition? So this was all so far as cost of acquisition of that strip of land which I have surrendered. Now come to the second aspect, cost of acquisition of the development potential arising on account of DC Regulation 91. No cost theory, we have discussed about that. So that according to me should be fine. Is the exemption under Section 54 available? So our practice of getting Section 54 deduction, exemption, etc. Here, what is being sold is the development potential and not the land of building. If I'm right in that view, then 54 is not available because I'm not transferring my flat. So what I'm transferring is my share or my right in the development potential. And therefore I will not be eligible for 54, but I should be eligible for 54F. Then when does the transfer take place? So here now we are on transfer of these development rights. You have section 247, which are two clauses. One is allowing possession of immovable property in part performance of contract 53A, and then any transaction enabling the enjoyment of the property, clause 6.5, and 6 other relevant clauses. You have two decisions of the Supreme Court dealing with this issue, which may be relevant, may not be relevant, may be relevant, certainly relevant for other development contracts, may not be relevant from the society's point of view, but let us quickly go through this. In Sesasai, the facts were that the agreement to sell of a land in 98, consideration was fixed. Both the parties are entitled to specific performance. Seller gives permission to the buyer to start advertising, selling, construction on the land. Power of attorney executed in 98. But there was a compromise agreement which happened in 2003, under which various amounts had to be paid by the builder to the owner so that a complete extinguishment of owner's right would take place. So on these facts, the Supreme Court held that transfer happened not in 98, but in 2004-05. A mere permission to start construction is a license to enter upon the land for a purpose of development, and such license cannot be taken to be a possession. Possession denotes control over the land and not just actual physical occupation. The phrase enabling the enjoyment in 247 must necessarily mean enjoyment as a perpetuate owner. The idea is to tax a transaction where, though title may not be transferred in law, there is in substance a transfer. So this is one decision at what point of time it gets transferred. From the point of view of society, that may not be very relevant because as I said, there is no transfer of immovable property ultimately happening. That today is only a licensee and tomorrow there'll be a transfer. That is not happening. So again, Balbir Singh Maini, this was a JDA between the society, original developer and subsequent developer. So there were two, original developer was there and a later subsequent developer. Land owned and registered in the name of the society. Members of the society were beneficial owners of the plot of different sizes. The agreement for irrevocably and unequivocally assigning in perpetuity the development rights for developing, licensing and selling and transferring the title. So this agreement had an element of transferring the title also, because this was a plot type of a society, not a building type of a society. Then that T, that subsequent developer, was to develop the land at its cost. The consideration to be paid by T through H, that is the first developer, to the members in cash based on agreed milestones and also by allotting flats. The third milestone was receipt of approvals from the authorities. Owner to execute in favor of T the sale deeds of part of the land parcels based on the milestone payments. Owner also had a right to terminate the agreement in case of default by it in making payment and allotment of flats to members as agreed. And it was held that clause 5 is not applicable because it says it's transfer property, allowing part possession of contract of the nature of 53A. They say that registered document is necessary. If there's no registered document, 53A of the transfer property, it does not come in. Elaborate discussion is there as regards the amendment on that issue. We'll not get into it. But 5 not applicable. And 6 also they said clause 6 not applicable because enabling the enjoyment of takes color from the earlier expression transferring, which means a de facto transfer. Though a legal title is not passed, it implies enjoyment as a perpetuate owner. In the present case, the owner remains the owner throughout the agreement. At the highest, the possession alone is given, and that too for specific purpose of development. And in coming to this conclusion, certain two facts which heavily weighed on the Supreme Court in arriving at this decision were two. One, payment under the third installment were only after the grant of approvals, which has never happened. So in that case, the approvals never came and that entire project had to be later on aborted. So that it never happened. The department said that although it is aborted, transfer had already happened. So here they said that that payments was only after the grant of approvals, which never happened. And therefore, that was a very relevant fact in deciding the matter. And second, the owner had a power to terminate the agreement and no conveyance had to would take place. So there was a power of termination. So in both these cases, there was an ultimate transfer of title, which was contemplated. In society's case, as we saw, that there is no such contemplation of transfer of title, and therefore, strictly speaking, these decisions are not applicable. So the question is that what is relevant in society's case? How do I find what is the point of time at which the development potential is transferred? So I have listed out certain items based on my understanding of that. There are some tribunal decisions also to this effect, but I've culled out and tried to make certain a summary of it. If the transfer of this development right is unconditional, I think it would get transferred when the power of attorney is granted to get the plans approved and exploit the development potential, because it is at that time, it's unconditional transfer. If it is conditional upon plans getting sanctioned, then the transfer gets complete on approval of the plans. If it is conditional upon getting IODCC, it gets transferred at IODCC is received. If it is agreed that the development potential has been transferred in stages or on completion of milestones, it will get transferred at that point of time. So if there is a development project of multiple buildings, you can probably use this to transfer in stages, and therefore there is no immediate transfer of the whole development potential. If the agreement is made terminable in case of a developer fails to deliver the members area, then the transfer happens on the delivery of the members area. So, but many a times I have seen in practice that the builder does not agree. They would say that no termination, only specific performance. So, but then if you are able to push this then and make it terminable, then it's possible to extend the point of time till which the transfer happens. If the agreement contemplates only specific performance is not terminable, but only provides for damages, then on termination, it may be difficult to argue that the transfer had not happened. So this is the sum and substance of what I feel is the point of time when the transfer happens of the development potential. Now come to the specific provision in the Act 45(5)(a) and whether it applies to society cases or not. What does 45(5)(a) says? Notwithstanding anything contained 45(1), so it overrides 45(1), where capital gain arises to an SSE being individual or an HUF. So this section applies only to individuals and HUF. It does not apply to any other SSEs. Capital gain arising from transfer of a capital asset being land or building or both. So once again here, like 50C, you have this language, capital asset being land or building or both. Under a specified agreement, what is a specified agreement? We'll see in a moment. Capital gains will be chargeable to tax in the year in which completion certificate for the whole or part of the project is issued by the competent authority. And then we are told that for the purpose of section 48, that is a computation section, the stamp duty value on the date of issue of completion certificate of his share in land or building, that is the owner's share in land or building, as increased by the cash which he receives, will be deemed to be the full value of consideration. So applies only to individuals HUF, and capital gain arising from transfer of a capital asset being land or building. These are the two important factors for applicability of these sections. Under a specified agreement, what is a specified agreement? Specified agreements means a registered agreement in which person owning the land or building agrees to allow another person to develop a real estate project on such land or building in consideration of a share being land or building or both, with or without consideration in cash. So this specified agreement. Now, question arises that whether 45(5)(a) applies in the case of society redevelopment projects. It applies to individuals in HUF. Society is assessed as body of individuals, and hence prima facie the section is not applicable to receipt by societies. Society does not transfer land or building. Also, the member does not transfer land or building. The transfer is only of the development potential, hence this section cannot apply. Now to test this a little further, can it be said that the member is transferring his flat in exchange of new flat? And hence, there is a transfer of land or building. Exchange is defined in the Transfer of Property Act, and two or more persons mutually transfer the ownership of one thing for the ownership of another. Neither thing or both being money, the transaction is called exchange. So exchange presupposes the existence of two properties with those two persons existing at the same time. And if the two properties do not exist at the same time, it is not an exchange. In the case of society redevelopment, the new flat and the old flat do not exist simultaneously. I am not giving the old flat to the builder and builder giving me the new flat at the same time. That is not happening, and therefore it is not regarded as an exchange in law. You have Supreme Court in Rasiklal Maneklal to this effect. Second, Rampur. Sales tax.
Service will not be an exchange.
Okay.
Yes, your point absolutely correct.
Rampur Sugar Mills sales tax.
Yeah.
Okay.
For an exchange,
Both should go.
until a service, until an asset
Cannot be an exchange. Okay. Rampur Sugar Mills. Dampur Sugar Mills sales tax. Okay. Okay. Thank you. Then the next question is this a case of relinquishment of an asset? Now, this creates a little bit of difficulty. You have Supreme Court in Grace College, which was concerned with the case of amalgamation of companies. And where in the case of, so SSC was a shareholder of a company A, and it received, that company A got merged with company B, and that shareholder received the shares of company B. And the question was whether that receipt of shares of company B can be regarded as a transfer of the shares of A. Why? Because transfer includes relinquishment. This was a larger bench of the Supreme Court which had to deal with this issue, because earlier the Supreme Court in Vanya Silk Mills had taken a view that even relinquishment should be in the nature of transfer, the same that I discussed about exchange. In fact, Rasiklal Maneklal also took the view that it is neither exchange nor it is relinquishment, because it is not coexisting at the same time. However, in the larger bench, the Supreme Court larger bench in the case of Grace College 248 ITR held that so far as relinquishment of an asset is concerned, it need not be in the nature of sale or an exchange. It need not be in the nature of a transfer as understood in the general law. Both the properties need not coexist. It does not require the existence of two properties at the same time. And thus it held that the shares of amalgamated company held by the shareholder were relinquished in consideration of shares of the amalgamated company. So if you consider this decision, obviously, there is a relinquishment of the old flat by the member. And therefore, what happens? Is there a sale of or a transfer of flat by the member? Am I right in taking a view so far? What we said that there is no transfer of flat, it is only development rights. Now, therefore, now can you say that there is development rights also and transfer of flat also? The answer to this is number one. What is the consideration accruing or arising as a result of? Is it arising as a result of transfer of that flat or relinquishment of the flat? Or is the consideration accruing or arising as a result of transfer of development potential? Cash compensation in the additional area have accrued to the member as a result of transfer of development potential, and as hardship compensation, no consideration is accruing or received as a result of relinquishment of the old house. Consequently, the question of replacing the full value of consideration by the stamp duty value of the new house under 45(5)(a) does not arise. Any other view that would take would really mean that there are two transfers and there is a double taxation, because you say that there's a transfer of development rights and therefore tax it under 45(1), and you say that there's a transfer of the old land and building and therefore tax it under 45(5)(a), and therefore there will be a double taxation to that effect. So, having regard to the proposition that the consideration which is accruing to the member is not accruing or arising as a result of transfer of his old flat, it is accruing or arising as a result of transfer of his share in the development rights to the builder. And that is what the development agreement would really say. And in that view of the matter, there can be no capital gain arising on transfer of the flat. Although there is a relinquishment, there is no consideration. And it is a settled law that in absence of any consideration, the question of taxability of capital gain does not rise. You have Taxpins Bombay High Court on that particular issue, which was case of Part 9 conversion, and that decision stood on two pillars. One is that Part 9 conversion by itself is not a transfer. And secondly, in any case, there is no consideration. So for both these reasons, they held that there is no capital gain in that case. So of course, the first part is not applicable, but the second part is still applicable, that in absence of consideration, there can be no capital gains. You have section 50D on the act, and the question arises that can 50D applies, because it says that the market value of what you have given up will be considered as full value of consideration. Again, 50D presupposes an existence of consideration received or accruing as a result of transfer. And because it is that consideration which I have to compare with the stamp duty value of what I'm giving away. And if there is no consideration received or accruing, 50D also does not apply. Giving possession of the old flat is a condition precedent for enabling the use of development potential that is transferred. That does not mean that consideration is received as a result of the transfer of the old flat. Based on this analysis, friends, I would feel 45(5)(a) cannot apply to the society cases. 194, now coming to TDS provision, you have 194(IC). And under 194(IC), there's a requirement to deduct tax at source. And it says that payment under a specified agreement, that's a title, notwithstanding anything contained in IA. IA is another provision which deals with transfer of immovable property being land and building. So it says notwithstanding anything contained in IA, any person responsible for paying to a resident any sum by way of consideration, not being consideration in kind. So we are talking of only cash consideration, monetary consideration. Consideration under what? Under the agreement referred to in 45(5)(a). 45(5)(a), we saw the definition of specified agreement. So consideration under the agreement referred to in 45(5)(a) shall at the time of credit or payment, which was earlier, deduct 10% of such sum as income tax thereon. The question is the development agreement in the society cases an agreement referred to in 45(5)(a)? We just saw that 45(5)(a) by itself cannot apply to the case of society. But that's not relevant in deciding whether the agreement is an agreement defined under is an agreement referred to in 45(5)(a). Here it is only, we have to see whether it is an agreement referred to in 45(5)(a). So what is the definition of an agreement? Specified agreement is a registered agreement. Yes, it will be registered, in which the person owning land or building, that is a society, agrees to allow another person, the developer, to develop a real estate project on such land or building. Yes, that's going to be so. In consideration of a share being land or building, so that additional area I'm going to get, with or without cash compensation. Yes, cash compensation. So therefore, it is indeed a specified agreement. Now, this is only a case of what is known as incorporation by reference. You are just referring, you are just, instead of copying and pasting this specified definition agreement once again in that section, you are only incorporating this definition by reference to 45(5)(a). And therefore, you have to restrict to that 45(5)(a) definition itself. You don't have to go to the other conditions which are required in applicability of 45(5)(a). And therefore, I would feel that in the case of society also, this development agreement is a specified agreement referred to in 45(5)(a), and therefore the payment which a developer makes, whether he calls it a hardship compensation, you call it a corpus, you call it a rent compensation, they are all payment under this specified agreement, and therefore I would feel that TDS under this provision would apply. And once this provision would apply, the other provision, that is transfer of land and building, 194(ia), etc., shall not apply. Then what we saw generally for a developer builder type of situation, let's now examine it closely from the society member and the developer type of a development agreement. So a member of a society or a society, what is it transferring? It's transferring the development potential or the proportionate interest of the development potential when it comes to the members. What is the member of society getting? The new constructed flat plus cash. And therefore, what is the commercial gain of that member? What he gets is the cost of construction of this flat plus cash. Now, I'll pause here for a moment. We have spoken about it, but let me give a little bit of more, put a little bit of more meat into this. That what am I receiving? Should I look at the cost of construction or should I look at the fair value of what I'm receiving? I have not transferred any land building. So the question of the value of land does not come in. If I would have incurred this expense myself, I would have incurred the cost of construction. And therefore, what is received by the member is the cost of construction of the flat, plus the cash compensation. This proposition is supported by several tribunal decisions. And I may just point out a few citations. It has not come out in the slides. And once again, thanks to Jagdish for all these citations, which was given to me yesterday. 67taxmen.com 147, Bangalore bench. 52taxmen.com 511, Bangalore bench. 89 ITD 73, Delhi. 22 SOT 58, Hyderabad. And there is a Kerala High Court, 62taxmen.com 305. So one High Court and several tribunal benches taking a view that what is taxable is the cost of construction and not the full value, as is really required in 45(5)(a) if you strictly read it. So the member gets the cost of construction plus the cash. What he gives up is the development potential. And if the development potential is has no cost of acquisition, then of course there is no tax. If there is a cost of acquisition, he pays tax on it. What a builder gets is fine. Sale proceeds of his free sale portion minus the cost of construction. That takes us to one interesting aspect of where the members are the owners of shops and commercial premises. What happens? Because when I am the owner of a residential flat and I am getting a new residential flat and I am entitled to 54F and I claim that exemption if there's a taxability. But a commercial flat owner or commercial shop owner does not get that benefit. So based on the theory that the member is transferring his old premises in consideration for new premises, we find that the members owning shops, commercial premises in a society building do not get 54 benefit and hence could be subjected to full taxation. Where they have claimed depreciation, the in and out of the block is popularly considered as under full value of consideration as stamp duty value of the new office, plus the cash consideration when 45(5)(a) people apply. This amount is taken as a base to compute Section 50 profit. The WDV of the office, assuming that it's the only asset in the block, is reduced. And the actual cost of the new asset acquired during the previous year is to be reduced from the full value of consideration to determine Section 50 profits. Now, since the transfer and purchase is not happening in the same year, there is a fear of tax liability. This is how it is happening today in many cases, because we are taking a view that there is a transfer of old premises and a receipt of new premises. Section 50 applies where full value of consideration received or accruing as a result of transfer of an asset, which forms part of the block of assets. Now, since there is no full value of consideration accruing as a result of relinquishment of that office, Section 50 has no applicability because it is transfer of a development rights and not the relinquishment of the office. It is 45(1) that is that applies to a transfer of potential development potential. And it is not Section 50 which will apply. Then, will there be any addition or deduction in the block for the future depreciation? So one is Section 50, we are taking a view not applicable. Whether there is any addition or deduction to the block of the future depreciation. Now, what is a commercial gain to the member? Commercial gain to the member is the cost of construction plus cash. If there's a cost of the setback FSI, we saw that there could be a proportionate cost of that strip of land which is given away. Then there's a proportionate deduction from the cost, which is embedded in the cost of my flat. But it can be reduced from the block only if it is received in cash, because money is payable in respect of asset falling. But what you can reduce in the definition of WDV is money is payable. If it is received in kind by way of an additional area, then it is not money is payable in respect of the asset. You cannot reduce it from the block. Then in respect of the development potential which came without cost, there cannot be any reduction from the block as its cost is not embedded in the WDV anyway. Cash which is received is generally hardship compensation that also cannot be added to the cost of the new asset. So what can be added to the cost of the new asset is the cost of construction of the new premises, which really gets added to the cost of the asset. Just to put it in a simple accountant's language, as an owner of a shop or an office, what is the entry that I'll pass? If I receive, say, cash, and I receive cost of construction of my area, then I will say cash account debit 50. Cost of construction relatable to my area is say 100. So these two are my debits. What is my credit? If there is a proportionate cost of the strip, or if there's a cost of the development right, which is not coming because of 1991, but because it is embedded in the cost of land for whatever reason, then to that extent, the cost of the old asset will reduce. So I will credit that. And the difference, of course, is my profit and loss. So cash account debit, cost of construction debit, old asset credit, and the profit and loss credit. That is my commercial gain. I have to recognize that profit, is it not? So that cost of construction debit really adds to my existing asset, because that is something which I'm receiving on account of the development potential which is getting transferred. So that gets added because now I'll be getting some additional area or whatever, which adds to the cost. So what is added to the block or what is added to the cost of the asset will have to be derived in this manner. So although there is no section 50 applicability, but there is a possibility of adding to the block in a manner which I just said, and that can give you a larger depreciation going forward. There are a few other issues. How much time we have? Taxability part, development rights. So there's no transfer of the shop. There's a transfer of development right. As we said that there is no transfer of land or building. The transfer is only of the development right. And because it's a transfer of development right, the taxability will not happen under 50. It will not, because it's not forming part of the block. It will not happen even under 45(1), but it will happen under 45(1).
So in that case, if there is a calculated capital gain, then whether that will be open to any exemptions if the assessee wishes to claim?
Yes.
Okay.
Yes.
Thank you.
Okay. So, but development right, most of the time you get out by saying that 1991, no cost theory, no tax. Most of the time, but it may not be always possible. Okay. So I have got 3 more issues. Yeah.
Just once I was exploring, you initially gave the Supreme Court decision, and then you explained how it is not applicable to the case of a cooperative society. When cooperative society transfers, gives the under an agreement the contract to the builder, and is not the society transferring the share of land also? Because builder is a conduit to my mind, and he is going to sell the flats, extra flats to the outside members or to the new members. So builder is a conduit in that ownership of the asset, the land. And that's how it is comparable to the Supreme Court's case in the first time you explained. That's what I
So those members
tend to think.
So those people to whom it will be sold will once again become members of the society. So they are the members of the society. So there is no conveyance of land which is happening. Land which was owned by the society remains with the society. It was always with the society. So as such, therefore, there is no transfer of land or building. Only what is transferred is development potential, because if development potential was not there, this transaction would not happen. So that's the whole underlying theory. Okay. Okay, quickly on these last three issues. Huh. Selling in builder himself becomes a member.
That amplifies your point. There is no transfer.
There's no transfer.
We get confused because builder sells in the market.
Builder sells.
But simplify it by saying builder himself retains the flat and becomes a member of the society.
He may also become member of the society. Okay. Okay. Can the no cost theory apply to a flat owners who have acquired flats after 91? So we are talking about development control regulations 1991, and therefore no cost of acquisition, etc. But I have acquired a flat after 91. Society is an old society. So if you consider member as also part owner of the development rights, then what the member has acquired, when a person has acquired a flat after 91, then can the no cost theory apply in this case? Can it be said that the cost of acquisition of their flats have within it embedded the value of the potential FSI? I would feel that the no cost theory will not apply in those cases, because the cost of the development rights are embedded in his cost, which he had paid to the person who sold the flat at that point of time. And you have the decision of Supreme Court in A.R. Krishnamurthy 176 ITR, which said that, where they tried to say that the leasehold rights transferred, there's no cost of acquisition. Supreme Court said the leasehold rights, the cost is embedded in the cost of the asset itself. And therefore, the leasehold rights cannot be regarded as no cost asset. So for a person acquiring after 91, I would feel that the cost, the no cost theory cannot apply. The cost of development rights is embedded in his flat, and therefore there'll have to be a computation of capital gain in this case. And the computation in that case would be cost of construction of my flat on a proportionate basis, add to that the cost compensation, minus the cost of acquisition of the development right, whichever way you may apportion the cost, your original cost to the development rights. That in substance would give you the capital gains. Then what happens in cases of self-redevelopment projects? So that is another aspect. A lot of incentives are being given for self-redevelopment by the corporation. Now, in a self-redevelopment, you are appointing a developer, but you are not transferring development rights to him. So there is no transfer of FSI, and therefore there is no question of capital gain as such. Society undertakes it as a venture. And when society undertakes it as a venture, what it does is it either collect funds from the members or borrows. Most of the time it will borrow, members will not pump in so much of funds. And then society will do the development projects on its own, and additional area the members will get by use of that FSI, TDR, etc. And the additional area it will sell. So at the end of the day, the society's P&L account will look something like this. On the credit side will be the sale proceeds of the flats. On the debit side will be the interest which it pays on the borrowings, number one. Number two, the members would still want hardship compensation because they are going ahead. Members would want some monetary consideration for themselves. Otherwise, the projects don't happen in practice. So they would want a hardship compensation. Then obviously there would be cost of construction. Cost of construction can be three parts. One is to the extent of the old area. Second, to the extent of the additional area to be given to the existing members. And third, the free sale area which the society will ultimately sell. So the cost of construction attributable to these three, that will be the debit of the P&L account of the society at the end of the project. The question is, will this so-called hardship compensation, number one, will it be considered as a valid cost to the society? And will the member be able to claim it as not taxable like any other case? To my mind, the answer is no. Society, as I said, is a representative of the members itself. You are entering into a redevelopment project yourself, and you cannot ask hardship compensation for your own resolution passed for constructing your own building. So I don't think that that theory of hardship compensation can ever sail through insofar as the self-development projects are concerned. Each individual, because if each individual were to construct, then he would have to anyway undergo the hardship. Whom will he ask the compensation from? You cannot ask compensation from yourself, it being a mutual body. So that theory won't work. So far as the cost of construction of additional area is concerned, so far as the society is concerned, once again, it is spending for its own members. And therefore, it is in the nature of mutual expenditure. Spending for your own members, part of a mutual association. And therefore, that expenditure which the society incurs for the area to be given to its own members cannot be regarded as a deduction in computing the society's profits. And therefore, when it comes to society's profits, the sale proceeds minus whatever the interest on borrowings, that also interest on borrowings attributable to the sale area. Interest on borrowings attributable to the members area may not be once again allowed. And minus the cost of construction of the sale area would be something which the society would be taxed on. So far as the hardship compensation and the additional areas are concerned, that is neither an expenditure for the society, nor is it income in the hands of the members. So therefore, the self-redevelopment projects are something which one may do. I mean, there is an enthusiasm that we will structure as hardship compensation, etc. I'm not really for it so far as the self-redevelopment is concerned. And finally, friends, in an owner-developer type of cases, now we are out from the society because there's a specific mention about tenancy in the scope given to me. In owner-developer type of cases, if there are tenants who get ownership premises in the newly developed building, how is their taxability going to happen? So we are now not on society. There is an owner and there is a developer. Assuming that the owner is individual, then 45(5)(a) would apply to him. And in the hands of the owner, therefore, the stamp duty value of his share on the date the CC is received, plus the cash becomes the basis for taxation, minus the cost of acquisition of his full plot becomes the cost, and that is a 45(5)(a) profit which he will offer to tax. Now, if that owner had a tenant, then the tenant gets the ownership premises, then the gain which is taxed under 45(5) will have to be reduced by the stamp duty value of the tenant's share, because that is not what he is getting. He has to give it to the tenant, and therefore either it is cost in connection with expenses in connection with transfer, or you just reduce it from the gain, whichever way you look at it. That will have to be reduced. However, insofar as the tenant is concerned, how he has to deal with it. The tenant is getting ownership flat on a surrender of his tenancy rights, because his tenancy rights get surrendered and he gets a flat. The stamp duty value of his ownership flat is what he's actually getting. He was never the owner of the land earlier, right? So it's not just the cost of construction that you look at so far as he is concerned. So what he's getting is the full value of the flat, minus the cost of acquisition of the original tenancy, if at all there's a cost, otherwise it will be zero. And that would give rise to taxable capital gain in his hands. If the new house which he is acquiring as a tenant is a residential house, he will get 54F because in lieu of tenancy rights, he's getting an ownership house, so he'll get 54F. One will have to make sure that under the agreement, the tenancy continues till the last date, till the date he gets possession of the flat. He should not cease to be tenant. So it should not happen that tenancy has been transferred in year 1 and he gets the house in year 3 or 4, in which case the period for 54F may expire and there can be some trouble. Now, the real problem arises where the new premises are commercial premises. And if they're commercial premises, then you don't have any deduction of 54F and the tenant may have to pay full tax on the full market value. And I do not know if this has to be avoided or this has to be eschewed. Then one will have to look at specific instances and sit down and brainstorm. But one very broad thing which I can just bounce it off is that if you have got enough time, then let that first let the tenant acquire the reversionary rights from the owner, and he would pay stamp duty on those reversionary rights, which would be some 200 months rent, I'm told. And then all the co-owners would transfer. Then that tenant would now become a co-owner of that reversionary rights which he gets. And then all the co-owners would then transfer the development rights. And then once they transfer the development rights, if the tenancy, we are talking of commercial premises, most of the time commercial premises may be in the tenancy may be in the name of a firm or a company or an LLP. In such cases, you avoid 45(5)(a) route. And then you end up paying tax only on the cost of construction. And that is how we may possibly, mitigate the tax incidence in such cases. Well, friends, I think I have exceeded my time limit. But then I've tried to cover as much as possible so far as the society, the redevelopment is concerned. If there are any questions, I'll be happy to take it. Otherwise, thank you all very much for a patient hearing. The tenant. So it surrenders his tenancy. No, here we are on owner developer situation. There's no society situation. So it's a typical old landlord owning the entire building and there are 10 tenants over there. And now that landlord wants to exit, he sells it to the developer. Now what happens? So there's a development agreement. The owner really also wants the upside of the development project. So there's a development agreement, and therefore the question of tenants also getting the ownership premises, how do we deal with that? So, if it's a commercial premises, then they do not get that 54F benefit. And that is where the whole matter is.
No, the tenant transfers this flat before the society is formed.
Society will be much later on.
Yeah.
Society will be much later on.
So what is the tax the tenant will pay?
So, okay. So we are talking of commercial premises. So if
residential premises.
Residential premises, anyway, he will be 54F. So then it will be a short-term gain for him at that stage. He would have got 54F, but then that 54F, if he sells within a short period, that 54F which he has gained would be lost. So there are some risks if he sells within that period. And in any case,
beyond 3 years.
That is beyond 3 years. That's right.
So then he gets the benefit, right?
Thereafter he gets the benefit.
Okay. Thank you.
Yeah. Correct. On the basis that there is a transfer of development rights.
Now, which year we should offer that?
Yeah, transfer of development rights, we said, which year would the transfer of development rights happen? The transfer of development rights would happen so that therefore those 7-8 conditions, if it is unconditional, it happens when the power of attorney is exercised. If there are conditions attached to it, then based on the conditions that transfer would happen. So we went through one of the slides there.
Each member will have to offer accordingly in his own.
I would think so. So one will have to plan the affairs in a manner that, you put in conditions, you put in the termination clause, etc. Then you are able to push that date of transfer as much as possible. There are a couple of tribunal decisions also to say only when you have ultimately received the premises. Okay, but there are tribunal decisions to that effect. In a case of dire need, you can rely upon that, but I'm not too sure whether in capital gains, that's the correct position or not. Yeah.
A very small query. You mentioned that the income, if the resolution is passed, and the income would be taxable in the hands of the members. So under what head would it be taxable?
So transfer of development rights or my share in the development rights, it's capital gains.
Capital gains.
Sir, if I am transferring a flat which I had purchased before 91, old flat, in a prospective redevelopment building, I'm transferring before the redevelopment happens. Whether I can bifurcate my consideration into the sale consideration into one towards the flat and part of it towards the development rights, and then apply the no cost theory for the development rights portion?
Sounds difficult because the stamp duty value of the land and building would factor in the entire value, and your 50C would tell you that you should not charge lower than that. So that bifurcation to me seems to be difficult, although one will have to explore your old decisions that you can bifurcate into land and building separately, and land could be long-term, building could be short-term. You have those Rajasthan High Court initially in Vimalchand Golecha and other cases where they allowed such bifurcation. We might to explore whether that is possible to do this, but prima facie, I think it's difficult because the value gets embedded in it. Okay, friends.
I have a similar query that if I am an owner of a property, and if after the consent has been given, like if the development rights have been given to the builder, and in between that duration, if I would like to sell my flat. So two questions, like one, what would be the asset that I'm selling? Like if I want to transfer that right, so it would ideally be development rights that I'll be selling to someone else in place of, when the construction would be completed. So so for say example, it takes around 2 to 3 years for the flat to be developed. And in between that, if I want to sell that flat, what would be the tax implication in the hands of the of that individual?
So you haven't yet vacated the flat. There is a development agreement already entered into.
But it has been demolished and the construction
If
is
it's
ongoing.
demolished, then it's only your rights under the development agreement which are getting transferred.
Correct. So what would be the asset and the source of?
The asset is your rights under the
Rights.
development
So
agreement.
it would be capital gain.
It would be capital gain.
Okay. Thank you.
Difficult to answer, but I think your cost would be the cost of your original asset.
I think since we're running short of time, we take last question from the ma'am. Yes, ma'am.
Yogesh, the period of holding for the new asset that I acquire should be reckoned from the old asset, or should be reckoned from the date I get the possession of the new asset?
No, from the date on which the new asset is actually acquired, not the old asset, because at the time of acquisition of the new asset, the taxing event has already happened. Okay. So you're saying that if there is a transfer of only development rights and there is no transfer of flat, then you can, yeah, you're right. You can calculate you can consider the old period. You're right. Sorry. You can consider the old period because I have transferred only the development rights. I have not transferred the flat.
Thank you.
Yeah, you're right. So that is the question, that if we go on the theory that the transfer which is happening today is only of the development potential and not of the flat, not of land and building, then the old period will have to be logically counted, and therefore even if you are selling today, it should be long term. Okay, but if the present practice which is going on is right, then they will say that, okay, you take the current date and therefore your gain will be short term. So based on the present practice, there's a problem, but based on the theory, which I think is a correct theory, you can take the earlier period. Cost of your original flat. So 2001 market value. No. So that area you have got as a result of your development rights. That's it. So it might have in fact even increased the cost of your acquisition, and we just saw that, you know, that your cost of acquisition has probably increased a little bit. Sorry? For tenancy rights, yeah. No. That theory will not work for tenancy.
Great.
Okay. Thank you so much.
Can we have a huge round of applause for Yogesh Thar, sir, from our physical as well as virtual participants? I think an excellent start for day one of DTRC, the 4 days refresher course. Thank you so much, Yogesh ji, for an excellent session on the taxation aspects for redevelopment projects. I think that was very enlightening with all the live cases. Thank you so much. Thank you to all our council colleagues, Central Council Member Mangesh Kinnare sir, Chairman Murtuza Kashwala sir, and all our RCM colleagues as well. And thank you very much, all participants. See you on the next Saturday for the next session at DTRC. Thank you so much, everyone. Thank you. Have a good day.